Good morning, everyone. I'm Brad Smith alongside Julie Hyman. This is Yahoo Finance Live. Let's get right to the three things that you need to know to start off your morning. First thing you need to know, a huge deal in the European banking space as UBS buys arch rival Credit Suisse for over $3 billion in a bid to shore up the global banking sector. The embattled bank's shares plummeted in the biggest one-day fall since 2008. The price per share now marks a 99% decline from their peak. Credit Suisse shareholders will get one UBS share for every 22.48 credit shares that they hold on to. But bondholders with the bank, they weren't so lucky in a massive blow that startled investors. $17 billion in risky AT1 bonds are set to be completely wiped out in the takeover. The second thing that you need to know, world markets reacting to the volatility. In Asia, stocks underwent a flurry of heavy selling on the Credit Suisse UBS news, closing with losses. European markets also opened lower with banking shares taking the biggest hit, the likes of Deutsche Bank and BNP Paribas trading to the downside. In the U.S., regional banks, they continue to be the focus, with shares of First Republic slumping in pre-market after being downgraded by S&P Global. That's the second time in less than a week. And the third thing that you need to know, what does it all mean for the Fed? In the immediate aftermath of Credit Suisse's deal, central banks across the globe, they joined forces to make sure the U.S. dollar remains available across world markets. This all ahead of the Federal Reserve's crucial rate decision on Wednesday, where they will determine whether to hike interest rates again. Many economists predict a quarter-point rate hike is on the table, although others argue that recent bank turmoil should prompt a pause. Well, UBS's takeover of Credit Suisse was supposed to calm fears of a banking contagion, but anxiety is spreading across the industry. Data shows that bank deposits for both small and large banks are on the decline. And joining us now, we have Gerard Cassidy, RBC Capital Markets Managing Director. And Gerard, one thing that I wrote down in my notes is this is an acquisition by any other name, as proven through the UBS's chairman's own statement within this, that this acquisition is attractive for UBS shareholders. But let us be clear, as far as Credit Suisse is concerned, this is just an emergency rescue. Give us your perspective on the matter.
I think you summed it up very well. This was a transaction that was driven by the banking regulators and the Swiss National Bank over in Switzerland. Clearly, Credit Suisse had serious problems, as you might recall, 6 to 12 months ago. This has been an embattled company for a number of years due to some poor management decisions. And it all came to head over the weekend as the deposit outflows accelerated for Credit Suisse last week. UBS was there with the help of the Swiss National Bank to put together a deal that over time will benefit UBS's shareholders very nicely.
Gerard, I'm trying to sort of figure out and piece out what is happening this morning. And thank you for joining us, by the way, because you're a great person to help us figure out what's happening here. I guess what I'm trying to figure out is, are there now still concerns of more of a ripple effect, that there will be bag holders, so to speak, on the other side of Credit Suisse assets, and let's leave AT1 aside for a moment, that will now cause other things to fail, to have write-downs at other banks, et cetera? Or is it that there's widespread concern about higher funding costs and capital costs for banks across the spectrum?
I think it's more the latter than the former, because as I mentioned, the Credit Suisse issues really, started to be quite severe 6 to 9 months ago. And so counterparty trades and other types of activity with Credit Suisse, guardrails were put in place. Not that anybody was expecting what was going to happen this past weekend to happen, but clearly there was, guardrails put in there, controls and procedures. There will be some higher costs to banks, particularly the banks that rely on these bail-in bonds that you referenced. Those are the European banks. The American banks do not use that in their capital structure. So that certainly banks that do use that will certainly need to see higher costs due to the fact that those bail-in bonds were effectively wiped out to zero.
Are bank clients in better or worse position when you do have consolidation like this taking place and at type of fire sale prices?
It's an interesting question, because what you're likely to see is that the larger the bank, you arguably should be more stable. It's more important, obviously, to the economies in which they operate, in this case, Switzerland, for the case of UBS. But the question is, what level of customer service will a client receive? Will it be as good as what it was before? I know here in the United States in particular, one of the real advantages going to a regional or a community bank is the much higher level of personal service the customer receives versus going to one of our very large universal banks that offer, great service, but it just doesn't have that personal touch that you get from a community bank or a small regional bank.
Gerard, FINMA, which is the Swiss financial regulator, had a quote that I thought was really interesting. It said that Credit Suisse experienced a crisis of confidence and, quote, there was a risk of the bank becoming illiquid even if it remained solvent. That is, even if the balance sheet was okay, even if its Tier 1 capital ratio was okay, which it was seemingly, if the market doesn't believe it, then it might as well not be true. Is what happened over the weekend, has that ended the crisis of confidence broadly for the banking system, for financial stability globally?
I think it's taken a huge step forward to improving it. Absolutely. This was a very big deal. This was the weakest global financial, company on the spectrum. So this moves us much closer to more financial stability. You never say never, but clearly this is the step in the right direction. And I think as each day and each week goes by and the stability improves, it will show that this was the right move by the Swiss National Bank, but also, the global central banks, whether it was the Federal Reserve, the ECB, giving support to what the Swiss were doing. That certainly is a real positive.
Even with this emergency rescue, is it ever expected, at least from UBS's perspective, that Credit Suisse will be a profitable asset within their business?
It should be, because the cost savings one can generate from combining two companies that have such overlap arguably should be very profitable to the acquirer. Now, it will take time. They've been very clear it will take time. They have different rules and regulations over in Switzerland than we do here in the US in terms of downsizing. But one of the reasons why, in fact, you look at the New York Community Bank deal acquiring Signature Bank over the weekend from the federal FDIC, is going to be very profitable to New York Community. And part of it has to do with the cost savings you achieve, but also you write down the assets coming into the transaction and you're getting them at fire sale prices. And as things stabilize, these types of transactions over time can be very profitable to the acquirer and their shareholders.
So since you mentioned New York Community Bank, which of course the shares have been going up on that deal, as you mentioned, I do want to move to First Republic and to the domestic regional banks, because First Republic shares are down in pre-market trading. That's after Standard & Poor's Global cut the regional bank's credit rating yet again over the weekend. What do you make of that, Gerard? What is going to be the future for First Republic at this point?
I think it's easy for us to say, or any investor, that the future for First Republic will be entirely different than what it was before the Silicon Valley debacle that started 2 Wednesdays ago. And the ultimate outcome for First Republic is difficult to say right now, but clearly they have the lines in place to handle any deposit flight. But as we know, borrowing off those lines is expensive, and that certainly hurts their margins, hurts their profitability. So if they can get through the deposit flight, which we think they can because of the deposits by those large American banks, as you're aware of, the $30 billion last week. But on top of that, they have access to Federal Home Loan Bank advances, as well as the discount window. So if they could stay through the deposit flight, then they have to reassess how profitable they can be with the model that they had created, which will certainly have to change on a go-forward basis.
For the regional bank turmoil that has ensued, how does that overflow even into the real estate market from what you're going to be tracking?
It's interesting because there is certainly concerns about the commercial real estate markets around the country, particularly the office markets in our big urban cities like New York or Boston, Los Angeles, San Francisco, even Chicago in the Midwest, because the work from home types of opportunities continue to persist and probably will stay in place for quite a long time, that these buildings are not completely occupied. So I think what you're going to find is over time, as the leases come up. This is not a 1990 period when a number of brand new constructed buildings came on the market at the same time, couldn't find tenants, and there was a massive problem in commercial real estate. We don't see it that way. We see a long grind down as the leases come up for renewal. Many of the Class A tenants may take less space because they don't need as much. So that will be certainly a challenge. And then as properties come up for refinancing, they're 5-year or 7-year term loans. They now have to refinance it. The capitalization rates are going to be higher today than when the loans were made. So there will be some challenges there as well. But we don't foresee it as being cataclysmic like it was in 1990, but it will be a challenge going forward.
And Gerard, sorry, just to circle back to 1 second for First Republic. So the parallels, and that quote I mentioned before, the difference between solvency and liquidity, that seems to be at the core of what's going on at First Republic now. As you say, even if the deposit losses have now stabilized, the market does not seem to have faith in First Republic. Is the difference then between a Credit Suisse situation and a First Republic situation what you were discussing in terms of the Federal Reserve funding that is available to First Republic?
That is one of the significant differences. You're absolutely right. But also, when you look at the model, one of the reasons the stock is not obviously it's down or expected to be down at the opening, is that the business model that they relied on, which was high net worth deposits at very low costs on the liability side of the balance sheet, and on the asset side of the balance sheet, it was a large portion of single family jumbo mortgages at low fixed rates. So that kind of strategy in the current rate environment is not very profitable, considering now the cost of funding has gone up so much. So I think the market's reflecting that even assuming they get through this period and they survive, that the actual profitability of the company is going to be greatly reduced because of the cost of funding having going up so much. So I think that's part of the reason that the stock is down, in addition to, of course, the uncertainty of the deposit flight and the impact that may have on the actual longevity of the company.
Gerard, really helpful stuff here this morning. Thanks so much. Gerard Cassidy, RBC Capital Markets Managing Director. Thanks.
You're welcome.
Well, UBS's rescue of Credit Suisse may not be enough to calm investors' fears as traders seek safe havens while assessing stability in the banking sector. All of these concerns surrounding the banking industry are sending gold above $2,000 an ounce for the first time in a year. It's now back below that level. Bank stocks have been, they've been bouncing around quite a bit, actually. We had UBS earlier lower, now it's higher. You've got that banking ETF that has been trading lower. But, some of the various individual stocks are bouncing around quite a bit this morning. And I think that's important to remember, too, that, yes, we've had the so-called flight to safety. That's been a fairly consistent theme here. But in terms of these individual stocks, they've been all over the map. We just saw First Republic, which is down. UBS was down, now it's up. Yeah. Credit Suisse is still down. But, I think what it is that there's just this real grappling to try to figure out what the effect of all of this is going to be.
Right, and from a stock picker's mentality, you might be asking yourself at home, is this a time to really position anywhere within your portfolio one of the regional banks that hasn't been hit as hard, potentially on the strength that you might see there? There's been a lot of kind of focus on even like the PNCs of the world, some of the more regional banks there, and even if they are able to make it through this most recent turmoil that we've seen within banking, does that have a stronger value to your portfolio than if you were to opt in to, say, a sector that did well last week over the past 5 weeks amid all that turmoil, and it was technology. It was semiconductors as well. Semiconductors stocks was up by about 6% last week. And so there's going to be kind of a picking and choosing, I think, among a lot of investors out there that are trying to decide, okay, even though we have had as much turmoil take place in a multitude of sectors, at this point, banks are the most recent fodder for conversation because of the severity of the closures that we've seen, the buyouts at fire sale prices that we were just discussing. But then additionally, it's kind of a positioning of how do I want to spend or allocate my own portfolio dollars right now. And I think for some of the rises that we did see within tech last week, that gives at least a little bit of a clear indication around how some investors might be thinking about this.
Right. I mean, at the same time, it was so interesting to see a lot of the regionals up, even if First Republic Republic is still down. New York Community Bancorp, which, as we mentioned, has now bought agreed to buy some of the assets of Signature, has been trading higher. There were some headlines that the FDIC has now extended the sale window for the assets of Silicon Valley Bank. Maybe they'll think they're still going to get a buyer for that. So that's sort of the micro individual stock pickers view. And then, of course, there's the macro view, people going into gold, as we mentioned. Yeah. The Treasury market movement this morning is interesting. We've got selling in Treasuries pushing yields higher, which is interesting given that we've now got a lot of debate on the street about whether the Fed is going to pause at its next meeting. So yields higher across the board, although they're still pretty low compared to where they were a month ago. But nonetheless, that's an interesting reaction as well to see this morning.
Yeah, that probability as of right now for the next meeting for a pause sitting at 41.7% according to the CME Fed Watch tool here. So that is elevated just a little bit more than when we came into even the beginning of this day here. So we'll continue to track that. Also, with uncertainty continuing to unravel in the banking industry, investors are also looking ahead to that Fed decision on Wednesday. The Federal Reserve is largely expected to hike rates by 25 basis points as the central bank moves forward in its inflation fight. We'll discuss what this all means for the Fed with chief economist from S&P Global Ratings later on in the show.
Well, writing in today's morning brief, Yahoo Finance's Brian Sozzi focuses on the wider banking sector, saying the crisis creates two key questions for investors. First, is the action to shore up the global financial system an opportunity to take on risk? And secondly, what does it do for banking stocks? Our next guest says despite the best efforts of government officials and central banks, investors do remain on edge regarding the future prospects of the banking industry. Joining us now, Michael Aroney, Chief Investment Strategist for the U.S. Spider business at State Street Global Advisors. Thanks for being here, Michael. It's always good to get your perspective. It does feel like there's a little bit of tentative risk-taking starting to creep back into the market. But as we know, man, that can change on a dime, can't it? So how are you thinking about your risk appetite this morning?
So I think what's interesting is outside of the financial sector, things seem to be okay in terms of the economy continues to muddle along. So the Atlanta GDP Now figure just from last week suggests that in the first quarter, the economy is going to grow by a little more than 3%. And I think Brad was doing a good job about kind of highlighting some of the areas that could kind of continue to perform well. So one of the areas that we highlighted back in November was in fact semiconductors. They were kind of their worst performance year since 2012. They were in the bottom 20 percentile of their valuation, highly profitable companies. And our view was that with the CHIPS Act and demand for kind of technology just generally, that this was an opportunity and something that had been beaten down pretty aggressively. So I think the key message here, Julie, is that selection is going to be key. And one of the things that we are really highlighting is dividend payers and growers and folks that can expand or grow their margins, because that's also been an area that's been challenged of late.
Michael, I welcome that vote of confidence in my commentary a moment ago, and that'll buy me at least 2 more days showing up to the desk here. I appreciate it. Just when we think about how investors can really shape their playbook right now during a banking turmoil that we've seen ensue and play out here, what does that playbook look like?
I think you start with parts of the market that are trading at a less expensive in terms of a price to earnings multiple. I also think that you want to look for good shareholder yield. So folks that are returning capital through either dividends or buybacks or both. And I also think, again, that kind of either high margins or expanding margins. So getting to kind of brass tacks here, what does that mean? We still like energy as a sector. We still like industrials. 87% of energy companies are going to increase their profit margins. Now, I know the price of oil is falling, and year over year earnings comparisons will be difficult in energy. And of course, folks are somewhat nervous that with a potential recession, demand will contract. But energy companies only trade at 8 or 9 times multiples. Their margins are very attractive, and they're returning capital to shareholders. Industrials is going to expand their profit margins by more than 25% year over year. So here again, we think that that's an attractive proposition for investors.
Michael, I don't think I've heard you say banks or financials in there anywhere. Do any of the financials at this point meet those criteria you were just talking about, or is that just a sector you just want to avoid right now?
I think what's interesting is that the bigger banks could be the winners here. So I continue to hear anecdotally around folks fleeing some of the regional banks and headed towards some of the bigger super banks like the Bank of America. Now, Julie, you know I'm not a stock picker per se, but it does seem to be a transition from some of the fears regarding the regional banks to maybe the net winners are going to be the large kind of bulge bracket banks. And that may be a shift. So maybe larger money center banks like the Bank of America, JP Morgan, for example, may benefit if in fact now all of the banks are going to have to play on the same kind of level playing field from a regulatory perspective. And depositors are concerned about their assets. They seem to be heading to larger banks. And I do think that those could be beneficiaries. And they do meet some of the criteria I outlined. They are cheaper, they have good profit margins, and they're returning capital to shareholders.
Even as some of those larger banks consider what's taking place with regional banks and where they are either sputtering or perhaps failing in some instances, does that mean that we need to reevaluate how we think about their own expansion efforts, even if they decide, hey, we're not going to go out and try and buy this regional bank or save a regional bank, but we might decide to play in the same space where we may not have already? Does that change the calculus around how some of the bigger banks may operate in the future?
I don't think so, Brad. I think that those banks are already operating in some of those areas, and they'd be happy to kind of continue to increase scale. And so I do think that, you know, some of these bigger bulge bracket banks would be interested in the opportunity to kind of move down market, if you will, and provide kind of a full service to the regional bank depositor. I think for them, because of the scale, they don't have to increase their costs so much to do that. They're happy to kind of come along and attract those depositors and those banking clients. And I think that is what is happening now. So again, anecdotally, I continue to hear from clients that, you know, people are moving their assets from those regional banks, and most of them are going to places like Bank of America. I do think that that's a natural kind of transition, and the bigger banks could be natural beneficiaries. There's a perceived safety around moving those assets. Now, whether it's real or not, I think we'll find out, but I do think that there is this perceived safety of moving up in terms of those larger bank and deposits to those larger banks.
You know, Michael, you sound pretty calm here this morning. I just kind of wanted to note that because I do think there is this concern, you know, you see the headline European banking crisis, right? And that can definitely cause alarm for investors, create echoes back to 2008. Are you calm? Like, do you think that this is going to end up being a bigger deal, not just for the banking sector, but for markets more broadly, for the Fed, et cetera? Or do you think that people are getting a little too worked up about it?
I'm reasonably calm. I think that it's clear that government officials, central banks, and even the banking sector is doing everything they can to contain I even hesitate to call it a crisis, the challenges within the regional bank sector. And Julie, just a moment ago, you were pointing out, even today, if we look at those regional banks, a number of them are up so far this morning. And so it seems like First Republic is continuing to struggle, but many of the other regional banks are starting to kind of rebound. And so to me, that's a good sign that some of the measures that are being taken are at least calming some of the concern. So I'm reasonably calm at this point. I would need more information to get a little bit more frazzled, and I just don't think we're there yet. I think for me, the big key this week is going to be, for the very first time, the Federal Reserve, in a meaningful way, will have to balance its kind of inflation-fighting credibility with financial stability. They haven't had to do that yet in this tightening cycle, and this week I think is going to be key. So, for example, I think it was Brad that just mentioned 41% expect maybe that the Fed wouldn't increase interest rates. If they don't, to me, that sends a bigger signal that maybe they're a little bit more concerned. And then I would start to get a little bit more anxious. I expect them to raise rates by 25 basis points this week.
All right. Well, we'll see we don't have to wait too much longer. The suspense only lasts another couple of days. Michael Aroney, great to catch up with you this morning. Thanks so much. State Street Global Advisors, U.S. Spider Business Chief Investment Strategist, Michael Aroney. Thank you. Coming up, U.S. banking majors are off their lows, as we've been talking about in pre-market trade, as UBS and Credit Suisse's shotgun wedding aims to stem any wider fallout for the financial system. We're going to take a closer look at the U.S. regionals and the big banks when we come back. Shares of First Republic are sinking again this morning after S&P Global cut its credit rating for the second time in a week, with a warning that the $30 billion rescue deal did not solve the bank's challenges. The stock is down 19.5%, and S&P saying in this note it may not solve the substantial business, liquidity, funding, and profitability challenges that we believe the bank is now likely facing. We just talked to Gerard Cassidy of RBC a few moments ago, and one of the things he said, Brad, is that there are some challenges with the business model of First Republic in this environment. It's got a bunch of jumbo mortgages on its balance sheet at a time when rates have now come up, so it's just not as profitable as it was. That said, we still don't know what's going to happen. He thinks they can sort of, as long as they can kind of make it through this current period of turbulence, that they'll be okay, but we'll see if they do.
I mean, they've had 11 banks also just give them a massive cash injection of $30 billion in order to try and make sure that First Republic can still operate. And it goes to note a few things, the importance of some of the regional banks, but then also as well, just trying to reassure confidence in the broader banking system that you have a consortium of banks that are saying, hey, we'll reach out, we'll lend you a hand here, and to the point of an uninsured deposit, just to make sure that customers still recognize that the broader system is secure and that there are some of the federal agencies that will make sure that we can still prop up and see this business to the other side as well when it comes down to what that core business is. And that is really the crux of what S&P Global is saying here too.
Yeah, it is interesting here that, as we've been talking about this morning, the other regionals are higher on the day. And so there is now this differentiation that is coming into the market. As we also mentioned, New York Community Bank Corp has agreed to take over Signature Bank's deposits. It's a subsidiary Flagstar Bank, and analysts seem pretty positive on that, and those shares are trading higher. So that's something that we keep tracking as well as we track the action here in these regional banks. We've come up on here on the opening bell. on Wall Street. Our market check here is sponsored by Tasty Trade. You see Visa ringing the opening bell on this Monday morning. And we've been looking here at stock futures that have, it was kind of a journey overnight, I guess you could say, given the news that we got on the purchase of Credit Suisse by UBS for $3 billion, the equivalent of $3 billion. Looks like we're going to perhaps open up here mixed here this morning as we try to figure out how investors are assessing that action that was prompted by Swiss authorities, Swiss financial regulators who kind of forced the two together, so to speak. UBS did not want to buy Credit Suisse, but it was deemed to be sort of necessary for the Swiss banking system. So as we open up, it looks like we've got the Dow and the S&P in the green, the NASDAQ very slightly in the red. But given the sort of drama that we saw over the weekend, Brad, relatively muted moves.
It is, and we've turned mixed here for the major averages out of the gate. We saw that a little bit of it coming into play with the NASDAQ just before the start of today's trading activity. Take a look at the Dow, though, up right now by about 0.4%. I wanted to put this all in context. Over the past 5 days, fractionally higher by about 0.5%, so keep a close eye on that as we move forward throughout the rest of this week. The NASDAQ composite over the past 5 days, as I was talking about, and we'll get into in a hot second here, the technology sector has been doing well over the past 5 days. S&P XLK up by about 6% over that course of time, and so the NASDAQ holding on to net gains as it is a tech-heavy index. But here out of the gate, it is lower by about 0.25% there, so taking a bit of a breather. The S&P 500, past 5 days, up by about 1.7%, and then here this morning out of the gate, you're seeing it up 0.1%. Two things I do want to point out here, even coming into the start of today's trading activity. I'll give you a brief look at the 11 S&P 500 sectors, largely in positive territory. It looks like 9 out of 11 components in that 11 sector makeup there are in positive territory, but you do see discretionary and technology lower here on the day. Also want to take a look at crypto here, because crypto has been ripping to the upside at least over the past 5 days in this movement that we've been tracking with some of the banking turmoil that's ensued. Bitcoin's been up by about 12% over the past 5 days. You're seeing that cross and hold above 28,000. So that is something to keep in mind with some of the larger, kind of more volatile and risky assets. Even when crypto moves, makes a move like this, that is worthy of tracking here. Ether also up by about 6% over that period of time, but here down this morning just a little bit. So I'll put this back on intraday just so folks aren't like losing.
Yeah, I mean, it's really interesting because it felt like for a long while there, crypto had lost that haven status that it has had in fits and starts, right? I mean, it's referred to by its proponents as digital gold, right? And gold certainly catches a bid. Typically, when people are worried about the wider world, right, Bitcoin doesn't as consistently. So it's interesting to see that coming back. We continue to watch banks as well. I mean, I mentioned we've been looking at the regional banks, of course, as you look at the regional banks, I mean, there's a lot more green on that screen there today, Brad.
Yeah, absolutely. And just kind of putting this on, and we'll rank these in order of kind of the biggest moves that we're seeing there. Of course, First Republic, as we were just mentioning, that's still the largest move to the downside. That's lower by about 18% out of the gate this morning. But you are seeing a considerable move in PacWest Bancorp. That's moving higher by about 18%. So an entire opposite absolute value move to the upside there that it's seeing as compared to First Republic, but they're largely a larger comeback that we're seeing among some of these regional banks. I'd mentioned PNC earlier as well, and here we see that move, and that's up by about 2.7%, perhaps a little bit biased being that I'm from Pennsylvania, and it's a Pennsylvania bank.
And what about the big banks, too? Because originally there was some concern, right, that there would be spillover, particularly, less so it feels like from the regional bank stuff in the U.S. It felt like that the Credit Suisse situation was maybe more alarming to large bank holders. Yeah, UBS, what a comeback, right? It was down earlier. Now it's trading higher. And the company saying that this was an emergency rescue of Credit Suisse, but they want to make the most of it. It is going to really expand its business and make it even more dominant within Switzerland, right? Which the regulators normally, in normal times, would not have allowed that kind of acquisition. But now at this time they are. But the other banks, the U.S. banks, are holding up pretty well also. Yeah,
while we've got UBS pulled up here, and I'll kind of put this on a year-to-date view, just so you could see kind of this move that's taking place more broadly. Year-to-date still holding onto gains by about 3.8%, but you're right. The move is all about what has been announced over the weekend here in this emergency deal that's taken place. And the UBS chief executive officer had said that bringing UBS and Credit Suisse together, Swiss, however you're pronouncing it at home, pronounce it, acquired. Credit Suisse together is going to build on UBS's strengths and further enhance their ability to kind of serve their clients globally, deepen their best-in-class capabilities there as well. And it also gives them some broader international growth ambitions too. So UBS, typically on the announcement of a deal or an acquisition, you would see that company's shares moving lower, kind of pricing in the amount of capital that's going out the door. But given that this was a steal of a deal, essentially.
Yeah. Well, and speaking of which, you got Credit Suisse shares up there too, I think. Just to, maybe they're on there somewhere?
Yeah, here we go. Down 48% right now. And year to date, you're seeing that move as well here. As we had mentioned, already had moved and hit some of its all-time lows and 99% off of its all-time highs as well.
Yeah. As you said, UBS getting it at a big discount. Let's move on to some other movers. Shares of Foot Locker rising this morning, up about 7% after reporting strong fourth quarter results, but weaker than expected guidance. And the company is also unveiling its plan to expand its sneaker line and relaunch its core brand. This is at its investor day that it is holding at the same time that it is coming out with some of these numbers here. So on the, sort of a mixed picture financially, like comparable sales for the year, it says are going to fall 3.5% to 5.5%. That's not great, even after those fourth quarter results beat estimates. But I know you're digging into the company's new plan.
Yeah, this lace-up plan that they're calling it. And that's great until we all have self-lacing shoes, I guess. I guess it still applies. But at the end of the day, a few things that jump out at me from this new strategic business initiative, as they called the lace-up plan. They're going to be looking to, and I'm glad we got this on screen for our viewers as well here. Awesome job by our team. Expanding sneaker culture. One of them, they're looking to serve more sneaker occasions, provide more choice, and they want to push more distinction as well. So we'll get a little bit more clarity around what that greater distinction may look like. Also the portfolio, powering up the portfolio you're seeing there. They're going to try and relaunch the Foot Locker brand within this pillar of the plan. They're going to transform the company's real estate footprint, open some new formats too. And this is particularly interesting to me because what if you did see a more condensed type of Foot Locker footprint out there? Because this could mean shifting off mall, as they've talked about. They're going to also close some underperforming stores. That should be music to some investors' ears out there as well, especially getting rid of some of the unprofitable locations within their portfolio as well. And then the relationship with the customers as well, just to kind of bring this all omni-channel and the relationship with customers that they're seeing there on the screen. The loyalty program. Loyalty programs have done especially well for companies like Nike, a company that is looking to go and has gone more direct to consumer. That impacts a company like Foot Locker. And I think if Foot Locker can layer on that loyalty program or at least ramp it up even more, I know I'm within that program. They got my email address, so I guess I'm a loyalty program member. That's going to be a part of it as well and really just give them more of the optionality around the sneakers or footwear that they're buying, but then also just upsell even more so, getting kind of a taste profile of each of those customers.
Well, and given, as you mentioned, that Nike has been doing more direct selling, its relationship with Foot Locker does not seem as ironclad as it once was. And so I wonder if that's something they're going to be addressing more directly at that investor day. That sort of elephant in the room of the Nike relationship should be interesting.
Yeah, absolutely. So we'll continue to watch all of these athletic apparel companies. We've got one more to mention here. Retailer Bed Bath & Beyond. The shares are sinking after the company announced that it will request approval for a reverse stock split. The company plans to hold a special meeting March 27th to determine the split at a ratio in the range of 1:5 or 1:10, with the final ratio to be decided by the board. The move comes just a few weeks after Bed Bath & Beyond completed a public equity offering to raise over $1 billion. Shares lower by about 9% right now.
I mean, what can you say about that one? It's just been a killer.
It has been. It's been crushed so far.
Yeah.
Guys, coming up, it's not every day global central banks get together to make sure liquidity is ample in the financial system. So is the need to ensure dollar access being taken as a positive sign or as a red flag? We'll discuss that next. The Federal Reserve and other major global central banks around the world announced that they would work to make sure dollars remain available in an effort to stem any liquidity concerns in the global financial system. But how often does something like this happen, and how does it work? Yahoo Finance's Inez Ferre is here to explain it all. Inez.
Yeah, guys, so the Federal Reserve is now reopening daily swap lines. So what are these? A swap line is basically an arrangement between two central banks to exchange currencies. So let's say the Swiss National Bank says to the Fed, hey, I've got a bunch of Swiss francs and I need US dollars. So that's the exchange that takes place. Now, regularly, the Federal Reserve has this open every 7 days, but now it is going to a daily basis. And it's done this before on a daily basis, and I'll explain in a bit. But there are 5 central banks that are involved with this, including the Bank of England, the Bank of Japan, the Bank of Canada, the ECB as well, and the Swiss National Bank as well. So why would they do this? Well, when you have a banking crisis, banking worries, there are concerns that the depositors will want to take money out of banks. And this includes little banks in Europe, for example. So banks around the world, institutions around the world, many of them hold U.S. treasuries, and those U.S. treasuries are denominated in U.S. dollars. So let's say that a small bank needs to sell some of its U.S. treasuries. It needs to sell those in dollars, and another institution, another bank may buy those U.S. treasuries, but they may need U.S. dollars. So then they will go to their central bank and say, I need U.S. dollars to buy this. And that's where that central bank steps in and says, yes, we've got U.S. dollars because the Fed is lending us U.S. dollars now on a daily basis. And basically what this is doing is trying to calm concerns around the banking crisis, trying to calm fears, and trying to shore up confidence within the banking community overall. Now, the fact that the Fed has done this now on a daily basis, not the only time that it has done this. It's done this back in 2020, March of 2020, where there were liquidity concerns then, and also back in 2008 during the financial crisis. So basically, this is providing liquidity. It just keeps the liquidity going, guys.
Ideally.
Ideally.
Ideally, right? I mean, that's the goal of it.
Yes.
And it keeps the liquidity going, even if it doesn't necessarily keep market confidence in these various...
Right, and you have to take into account, is this the Fed panicking? It depends on who you ask, because they will say, well, look, they do this on a 7-day basis normally, so they're just increasing it on a daily basis. But the fact that they announced this on a Sunday, the fact that they announced it before the markets open, you just have to keep in mind that, yes, definitely the Fed is concerned, as well as other central banks, about this banking contagion going farther.
Yes, definitely. Thanks so much, Inez. Helpful to lay that out for us. Coming up, why the Credit Suisse rescue plan may not be a stable equilibrium in the long run, at least according to our next guest. We'll discuss. As UBS sweeps in to rescue Credit Suisse, our next guest warns that this is not a, quote, stable equilibrium in the long run, and the banking sector may be more fragile than before. Columbia Business School Associate Professor Kairong Zhao joins us now. Thank you for being here, Kairong. And, you know, does seem to be calming nerves to some extent today. But then talk to us about the bigger, more long-term picture and why it may not be a picture for stable equilibrium.
Yeah, for sure. Thank you so much, Julie. So I think it's kind of useful to step back to kind of recount what just happened, right? So we had U.S. regional banks, which account only less than 1% of the total assets of the U.S. banking system. And its failure actually triggered the collapse and eventual bailout of a global systematically important bank, Credit Suisse, which has survived 160 years, right? And the fact of this kind of the fragility in the system is mind-boggling. So it shows the lack of confidence of investors in the current banking system, although we know that there are tons of new regulation have been installed post-2008 financial crisis, but it seems that it didn't really manage to address those fragility in the system. Okay. So we know that today, after this news has been released, in the short term, it helps to calm the markets and investors understand that the regulators and the policymakers are willing to do whatever it takes to save the banking system. But this is just kick the can down the road, right? Kick the can down the road. So also in this kind of a really rushed bailout, it exposed some of the confusion that stemmed from the post-crisis regulatory reform. So for example, some of the bond investors was shocked to know that even if equity holders get bailed out, their bond value essentially gets completely wiped out. This really took some investors as a surprise. And then they kind of realize and they go back to read all the kind of the covenants of the bond and realize that this is already written in the fine prints of the bonds. So I think there's a lot of shock in the so-called Cocoa bond market, where essentially it's kind of a new thing installed by the regulators after the financial crisis. So not everyone investors are kind of aware of these small intricacies, and then the ECB have to come out to kind of clarify that this is just a sweet thing, right. And all the kind of European banks don't have that issue. So I think it is good that this bailout came very fast and helped to calm the market, but it do kind of expose some of the kind of fragility in the system.
Sure. So we had a guest earlier that said, I would hesitate to call this a crisis, but for investors who have absolutely seen the wild swings that have taken place and ensued in everything from banks that are directly exposed to some of the collapses that have taken place, or those that are really just kind of on the fray of this or on the fringe of this all, is there calm that you believe will enter into the markets?
Yeah, definitely. So I think the fact that the regulator really act very swiftly, instead of in 2008, people debate whether we should bail out the banks, how should we do it? I think the regulator act very swiftly. That kind of clear out some of the uncertainty that the market participants may have, which is very, which is really good. However, as I mentioned, it does expose some of these ambiguities in the regulation. So I wouldn't say that now we can go back and sleep soundly. So I don't know how many surprises going to come down the road. So I think the regulator should take this as a good opportunity to review the system that we installed after the 2008 financial crisis.
Right.
You can up some of the issues.
But you can act swiftly without the swift action being correct, because what's been exposed is more of a systemic type of issue that we need to mitigate. Has that been mitigated?
Yeah, so definitely not. So that's a good point in the sense that, the regulators doing, for example, the kind of the wipeout of this AT1 bond, which is the additional tier 1 capital bonds. And a lot of investors had the impression that if it's a bond, so the priority should be before the equity holders. So if the government bail out the equity holders, these bonds should be saved. but they were surprised to know that actually these bonds get completely wiped out. So I think that's kind of the thing that, even if regulators and policymakers act swiftly, sometimes the market just don't understand, or it was confused about something that they didn't have time to digest. So for example, in this bailout deal, the shareholders of the two banks don't even have the right to vote, right? So essentially, the deal went through so fast, and we can see that the UBS stock price actually dropped before and then recovered afterwards. So it just shows that investors do need some time to kind of really understand what's going on. And I'm not saying that they understand what's going on, because Credit Suisse is such a gigantic bank. It's have like 2 times of the balance sheet of Lehman Brothers. There are so much complicated things going on. So I think investors still need some time to understand, what's there in the balance sheet, whether there's another bomb in the balance sheet that's going to explode later on.
And yet the bombs, though, are unique to Credit Suisse, right? In other words, the bank was unique and its problems were unique in many respects. Do you think that there is a broader systemic risk that is still yet to be discovered? Or do you think indeed we have had containment? And if there is more risk, where does it come from? What is it?
Yeah, so I do agree that Credit Suisse is having problem for a long time, right? So you have a governance problem. It runs from scandals. In scandal, you have a problem in their risk management. However, I don't think that's the problem is kind of confined in Credit Suisse, and the banking sector is saved just because of this bailout. The reason I'm saying is that this bailout really exposed some of the fragility, in the sense that now we have this Coca-Cola bank bond sector essentially shut down for the European market, because now investors realize, okay, there's something I don't understand, this new regulation which is installed after the crisis. Now maybe we need to step back and kind of understand all the fine prints. So these things are kind of what I'm talking about. It's not because other banks also have these issues in terms of risk management, but because the fact that there are new regulations sometimes are kind of complicated, and it seems that regulators hope they can stem out events like this, but it didn't. So it really shook investors' confidence. So this problem is kind of drastically different from US. So I think as a US investors, it seems that we don't need to panic right now, because we have a totally different problem, where the main problem is in the kind of mid-sized regional banks, where some of them have too much uninsured deposits, and these uninsured deposits are flooding. So it's a different problem from European banks, where the additional tier 1 bond market is shutting down, which spill over to HSBC, things like that. In the US, I think the problem that the regulator needs to think about is that how should we think about the uninsured deposits above the 250,000 insurance limits, right? So I think that is the key issue that may lead to problem in the US banking system. If, say, that investors lose confidence and they are systematically moving deposits from small or regional mid-sized banks to big banks, and these small, medium-sized banks start to fire sell their assets, I think that will be a problem in a US system, so which is quite different from the European one.
Yeah.
And so far, I don't see that being very likely. But again, if there's further surprises down the road, I think these kind of a spillover, not in terms of direct exposure, but in terms of the investor psychology, may affect US banks.
Most definitely. And I imagine that regulators and members of Congress will be deliberating whether to make some of those changes over the coming months. Thank you so much, Kairong Zhao, Columbia Business School professor. Appreciate your time this morning.
Thank you, Judy. Coming up, banking turmoil spreading beyond just the financial sector. We'll take a closer look at some of your key commodities as gold catches a bid on haven demand. That's next.
Want to get a quick check on commodities here. Gold's been seeing a steady rise after UBS's agreement to take over Credit Suisse was announced. The agreement to wipe out the value of Credit Suisse's risky AT1 bonds introduced, quote, a new source of uncertainty for investors, helping push gold upward, although gold has already been catching a bid as of late because the recent rise saw gold prices above $2,000 an ounce for the first time since March of 2022. It's not holding above that level right now. And then there's other stuff that is viewed as good stores of value, frequently referred to as safe havens or just havens, because safe havens is a little bit redundant in my view. Everybody says it. Silver, copper, they're also higher as well. So seeing a lot of money go into those areas. Oil prices on the flip side, they dropped to the lowest in 15 months. That downward movement fueled by concerns that global banking uncertainty could drive a recession, sapping fuel demand. The expectation that the Fed is going to raise interest rates by 25 basis points also weighing on oil futures.
Coming up, as investors digest the rescue of Credit Suisse, what does this mean for the Fed? That man right there, Fed Chair Jay Powell and his compadres. We'll discuss with an economist from S&P Global Ratings next.
Welcome back to Yahoo Finance Live. I'm Julie Hyman with Brad Smith. Let's check in on the market action as the banking sector continues to make headlines. Major averages mixed at this point as U.S. investors continue to digest the forced marriage of UBS and Credit Suisse, and international regulators really attempt to calm fears in the banking system. The Dow, which had been underperforming because of its weighting toward the banks, is now bouncing back. And let's take a look at some other things that we are watching here at the Wi-Fi Interactive. We have the 10-year yield, which I'm watching closely, which has been moving a bit higher. But put it in perspective here, it wasn't very long ago, in fact, just less than a month ago that we had it at 4%, which is right around this line here. And then we have seen that slump in recent days on the perception that maybe the Fed is not going to be raising at the next meeting, or maybe not raising by as much. We'll find out in a few days when the Fed actually comes out and makes its decision. And then looking at the various bank stocks that we continue to watch closely here, big banks are mostly bouncing back in today's session. Just taking a look at the equal weight, just to give you a better look here. Credit Suisse itself continues to plunge because UBS is buying it at a steep discount. So hence what's going on there. UBS itself, though, is up the most among the major banks. It's up about 6% in today's session. And then you've got mostly green on the screen amongst the other banks. So it does seem from an equity holder perspective that some measure of calm has resumed in markets here today. And it's mostly resumed in the regional banks as well. The one notable exception, of course, is First Republic Bank, which continues to be sharply lower after S&P downgraded it once again, the second time in a week. But otherwise, we've got some strength among the regional banks today. And then I know the trade that Brad Smith has been watching has been what's happening with technology, which has actually been maybe a little bit unusually a place that people are going for more stability here. That is a more mixed picture in today's session. Amazon and Microsoft standing out to me in particular. Amazon down 2.7%, Microsoft down about 2.2%. I'm watching NVIDIA this week too, and that's because NVIDIA is holding its big developers conference, its GTC conference. We're going to be talking to some executives there as the week goes on. Look at that year-to-date move in NVIDIA, although it's moving lower today, Brad.
All right, chips catching a bite, well, over the course of this year at least, coming off of last year. Switching gears to something that you mentioned earlier, Julie, the Fed. Investors intently focused on monetary policy ahead of the Fed's FOMC meeting this week as confidence in the banking sector, it wavers. Here with deeper insights on the Fed's rate hike path and the state of the economy, we've got Paul Grunwald, who is the S&P Global Ratings Chief Economist. Paul, good to have you here in studio with us.
Good to see you guys.
Absolutely. Okay, so help us dive in first into what the Fed's read on some of the banking confidence has been, how that might show up in their decision and in their conversation as well.
Right. Well, first of all, the job of the Fed is price stability, right? So they have a 2% inflation target and a full employment target, but obviously they need to be mindful of financial stability. Our view has been that the Fed and other central banks can kind of walk and chew gum at the same time, so they can use the balance sheet, which the Fed did over the weekend, right, to try to stabilize the financial sector, and at the same time free up the Fed funds rate if they need to continue to tighten conditions. Our view is that the macro needle really hasn't moved much yet. The risks have moved, but not the baseline macro needle. So bottom line is we still have an inflation problem, and the Fed needs to continue to raise rates. So they've obviously got one eye on the financial sector, but we still think they're going to go 25 basis points later this week. But the language should be sort of softer and slower. Right?
There are some strategists who suggested they forego the dots this time around as a way of still raising, but signaling, a little bit of a pause vibe. I don't know.
Pause vibe. I like that term. The dots aren't forecasts, right? They're just kind of the thinking of the various governors in the same way that, we put our thinking out a couple of days ago. So it's helpful in the sense that we know what the governors are thinking about main variables. But to your point, Julie, we think the tone is going to be softer, right? Even if the Fed goes 25, which is what we think, there'll be more talk about the downside risks. We may have a slower path up, but we still think the Fed has more work to do. And we've been saying this for the last year. Pausing and then having an uptick in inflation and getting behind again is not the best scenario. So it's really a balance of risk, but we think they're going to go.
Okay, and so to that extent, it sounds like you believe that even if they were to pause, in a pause scenario, that they would actually have even more explaining to do as to why they paused, what were the mechanisms, what they saw, and how severe it was that led them to pause.
Right. Well, it's a balance of risks, right? So they can, a month ago, 50 was priced in. If you look at the Fed funds forwards, it was 80% going 50 basis points in 25. And then it flipped. One risk is they still really go hard and then the economy slows and people ask why they tighten too much, or if they do nothing and then inflation takes off. So 25 seems to be the middle ground. But again, we've got an economy that's running hot. The last time we looked at the data, I know we haven't looked at macro data too much in the last week, but the unemployment rate's at 3.5 and we're kind of above our potential GDP path. So we've got to slow anyway, but it's finding that balance of bringing inflation under control and keeping the macro going.
We've talked to some other economists over the past week who have said the chances of recession have gone up markedly in the last week because of the events that we've seen. Because, if the Fed is going to raise another quarter point, on top of the already tightening financial conditions because of what's happening in the banking system, that double whammy is going to get us there.
Yeah, well, let's remember where we are in the macro, right? The story has been services fueled by a strong labor market, fueled by drawing down savings from the COVID stimulus plans, right? So the interest rate sensitive sectors, tech, capital goods, et cetera, they're already kind of weak or even borderline recession. So the narrative has been kind of this, labor market services story. If that's still got legs, then we go into sort of this slower growth path. But our baseline is still that we've got the Fed kind of flirting with recession later this year. I think the downside risks, as I said, have gone up. So we're still in flux. We just show that on the board. So if you look at our forecast and then kind of the risks around the forecast, they're tipped to the downside. But we're not ready yet to make the big shift and have a hard landing yet.
And so for what the Fed, and we continue to bring up what their dual mandate actually is versus everything that's actually happening as well, how can the average investor or even consumers right now kind of wrap their heads around where the Fed still has work to do, perhaps? Because they're still looking at even the price of eggs, which, came down.
Came down last month.
That's a good thing. But in their daily, day in, day out purchases, how do they continue to think about where the Fed is in this broader policy pathway? Yeah,
the way I like to explain it is we want low and stable prices. And that means, to your point, you really don't think about them on a day-to-day basis. Or you don't think about, is my real wage declining because inflation's picking up? So we economists have kind of interpreted that and sort of, codified that as 2% inflation targets. But the Fed is still facing 5-ish% inflation on core PCE, which they target. So there's more work to do, but if we get success here, we've got an unemployment rate that's a little bit higher, but more sustainable. 3.5 isn't really sustainable. And inflation's 2%, and we don't think about prices on a day-to-day basis anymore. So that's what they're really trying to do. It's just that in the last week, we've had this other thing thrown in, which is financial stability. So we've got three things going on, right? We've got the dual mandate of inflation and unemployment, and then with this other instrument, we've got financial stability. Nobody said central banking was easy. So there you go.
I mean, it certainly feels like we're a long way away from not thinking about prices, right? I mean, I went grocery shopping this weekend. I'm still thinking a lot about prices. I'm still shocked that I'm getting sticker shock, but it's still happening. I want to come back to the financial stability because we haven't really paused there for a moment. How concerned are you about financial stability? Do you think that what we've just seen is a banking crisis and that the banking system is in any danger from, as you think about it from your economic framework?
Yeah, we don't like the crisis term. We save that for very special events. 2008 is probably a good one. We've been tracking, we do this quarterly exercise in the ratings business called credit conditions. And we've been tracking interest rate risk for the last couple of years. And we've seen pockets of that risk materialize, right, with SVP and Signature and other banks. But, the banking sector as a whole looks in pretty good shape. We think the macro picture, again, as a whole looks in pretty good shape. But we're going to have some collateral damage as the Fed goes from essentially 0 up to, 5+%, which is where we have the base rate. So the best scenario is we have these pockets of risk, they're contained, and then we've got a policy response that seems to be well received. But nobody said it was going to be a straight line from the Fed going to 0 to the peak rate, and we've seen a little bit of that over the past week. And we will continue to watch that.
Yeah, definitely. Paul, good to see you. Thanks for coming
Likewise.
in. Appreciate it. Paul Grunwald is S&P Global Ratings Chief Economist. Thanks. We got a trending ticker we want to bring you now. That is Starbucks. The new CEO officially taking the helm of the coffee giant nearly 2 weeks earlier than expected. The official transition was expected to happen on April 1st after being named incoming CEO in September. He's going to mark his first public appearance as Chief Executive Officer at Starbucks' annual shareholder meeting on Thursday. And we're going to talk more about that in just a bit. Coming up, as UBS saves the day for Credit Suisse, who are the real winners and losers? We're going to break that down next. Let's do a quick check of the market sponsored by Tasty Trade. We've got a mixed picture for the major averages. The Nasdaq down, the Dow leading gains up 0.9%. That's in part because financials are the best performers today. And just glancing at some of the movers in the Dow, JP Morgan Chase, Goldman Sachs helping to contribute to gains there. But Caterpillar's also up by about 3% or so today, and Merck and Boeing, some of the other movers within the Dow. Well, the sale of Credit Suisse has brought a certain type of bond to light, additional Tier 1 bonds. Let's talk a little bit about what they are and why they are getting so much attention. First of all, let's talk about what typically happens in a bankruptcy. To be clear, Credit Suisse is not a bankruptcy, but it is clearly a rescue. And according to the SEC and, most econ textbooks and finance textbooks, first the secured creditors, those who have collateral against their lending, they are the ones who are made whole first in the event of a bankruptcy, then unsecured creditors, and then stockholders. Those folks in the middle here, they're not all getting made whole in this UBS rescue of Credit Suisse. And that's because of these additional Tier 1 bonds. Effectively, what they are, they're a type of debt, a special type of debt that was cooked up after the European debt crisis to help increase capital at some of the European banks. It helps them bolster their capital to meet regulations that are designed to prevent failure. However, if there is a failure, if there is what's called a distressed event, sometimes they can be converted into equity, that is, into stock, or entirely written down. It is the latter that has now happened in the case of UBS's acquisition of Credit Suisse. As a condition of its acquisition, it did not want to have to take on those liabilities, those bonds, because it wouldn't have made financial sense in the eyes of UBS. But what this means is now more than $17 billion of these so-called AT1 bonds are being wiped out. The folks who hold them, mostly centered in Europe, now will not get anything back on that investment. And that is being seen by some as quite controversial, even though this type of investment is seen as quite risky when you buy the stuff in the first place. And while some of those AT1 bonds are so-called COCOs, which is a whole nother diversion, they can be convertible into shares. The Credit Suisse stuff was not. If you looked at the fine print, which we talked about with our guest from Columbia earlier, it said that you were potentially going to lose your money. One of the people who is not very sympathetic to the view that these people should have gotten bailed out in some way is Jeffrey Gundlach of DoubleLine. He was tweeting about this earlier and effectively saying, well, that's not the one that we're talking about, but let's talk about a different one. Jeffrey Gundlach basically said he did not have sympathy for these bondholders because they should have realized the risk that was inherent in this type of investment. So what does the rescue of Credit Suisse mean for these bondholders, and what are the broader implications? Joining us now to discuss, New Edge Wealth Portfolio Manager and Head of Fixed Income, Ben Amons. And Ben, thank you very much, because part of that explanation there was sourced from some of your explanation that you had emailed to us. So when we were talking about these bonds, why is there such a kerfuffle over these bonds? Why is there so much, what is the deal? Why are people so upset about these?
Hi, Julie. Yeah, I think what happened here was that people did assume they were senior to the stockholder. And the reason was that after the financial crisis and after the European debt crisis, these securities were issued. They became part of the bank's capital to bolster the capital under the assumption that that would be leading to the position of the bank in excess capital versus required. And then the ECB, of course, supporting the banking system with lots of liquidity and banks buying sovereign bonds that went up in value and the ECB buying those sovereign bonds. All of that led to a capital position in European banks where those AT1 securities were issued for that was assumed not to meet any kind of write-down, no matter what would happen. And this is now what is not the case. What the Swiss regulator did was to say, if we're going to have a transaction at 76 Swiss francs per share for Credit Suisse to merge with UBS, the bondholders have to pay up here because the capital shortfall that would happen as a result of that transaction has to be made up by regulation. And if you then dive into that prospectus, as you mentioned, it's very clearly outlined in bold letters, like you have the risk to be written down completely to zero in the event of that sort of distress. And I think as a last point, the regulator here took a discretion to judge this, because the prospectus also outlines this. You cannot have a situation where the taxpayer must step up for a merger or distress event. It must be the bondholders. And I think this is why people are upset. They didn't realize this. And now you're seeing the fallout in the markets, in particularly that particular market, AT1 bonds.
How abnormal or even precedent setting is the move that the regulators have taken within this decision?
It is very significant, I think, because as we now understand that these securities can be written down to zero, you cannot assume they are "quote unquote" safe securities. People look back at the return of those securities, which, by the way, have been exceptionally high. They've done extremely well if you've held them in your portfolio. That is obviously not what you can expect going from here. The yields of those securities have to rise materially to account for that risk of write-down, even though that maybe some of the banks that have issued those bonds will never have to write down those securities. Nonetheless, the risk have to be repriced. And you can see this now in the spreads of those securities, whether they're issued by German banks, Italian banks, or French banks. The spreads are all up about the same amount, something like 300 to 500 basis points last time I looked. And that tell you that we're going to be at a more higher yield and spread level for these securities from here.
Ben, I'm curious, did you own any of this stuff?
No, fortunately, I did not. We're more involved in senior unsecured that is not with connected to any write-down clause. I want to make point here too that in the United States, these securities are not issued this way. They call preferreds, and they're senior unsecured as well, but they don't have any clause to be written down in any type of event. So I think people can look at this like a really European-specific issue across a number of banks. Again, to your earlier question, the broader risk implications that these banks have issued those bonds, they will go down in value, so they have to do something with their capital because they're part of the capital. On the other hand, the broader bond market seems to be less affected by this at this moment. I'm talking particularly financial senior unsecured debt. So yeah, that's where we're at the moment.
At the same time, is it going to be more expensive for banks, not just in Europe, but globally, to do business as a result of this?
I think we could say that because there's uncertainty about the banking system overall. Lots of not really clear language about what is this FDIC limit on deposits, for example. Also, the merger between UBS and Credit Suisse being pointed to that this was actually caused by the distress in the regional banking system in the US. And as much you can argue whether that is not or is, I think that all of that uncertainty drives up the cost of funding for banks. And as a result, you will see central banks pumping in liquidity into the banking system just to make sure that there's not going to be a major distress. Nonetheless, I think the cost of funding for banks will stay higher from here because of all these uncertainties that are surrounding it.
You've written that there's less likely contagion from the AT1s to U.S. bank preferreds, but there's also some carry through to what this means for U.S. large cap bank stocks. So what would that be from your perspective?
Yeah, there's always a form of correlation between the markets, no matter what, because if one bank doesn't do well, it just affects all banks everywhere. People judge it like that risk in Europe that's increased must also be accounted elsewhere. But I do think you're not dealing with obviously the similar situation because there's no write-down clause in these securities here in the U.S. I do think that the U.S. banks become obviously larger here, will get more deposit inflow, but also be perceived as banks that are even more systemically important than before. So that designation, which played a big role here with this UBS Credit Suisse merger, is something that for investors is important, because if that were to be watered down, then I think we're getting even more distress than we're experiencing currently.
One other quick thing I want to mention is, we've been talking all about the bondholders. The equity holders, they didn't get nothing, but they didn't get much, right? In terms of this UBS acquisition of Credit Suisse. The Saudi National Bank, which, as we talked about last week, is a big holder in Credit Suisse. They lost something like $1 billion on their investment. So in the wake of all of this, from an equity perspective, how are you thinking about investing in the banks or not investing in the banks?
Well, you can certainly invest in banks. I don't think that this is just all out and done, and therefore, you have to completely rotate out of financials altogether. But it does indicate, the winners and losers, the strong versus the weaker banks. And this has been a process, I would say, dates back even from the 90s, when you saw a lot of mergers, and then on to the financial crisis with its mergers, and now again. So I think the conclusion is that you could probably see a new wave of consolidation coming through. Fair bit of data is out there on that type of, how many consolidation could happen, because it is about scale of economy and about, money on the move, the seeking for, well, if my money is not safe at one bank, I'm going to go to the one that I think is safe. And that's what individuals will do and what investors will do. So I do think that banks are an opportunity to invest in, but you have to do your homework, and people will look again at metrics of debt and metrics of equity and determine there if these banks run sound lending models and have limited leverage. That's probably an opportunity to invest in.
New Edge Wealth Portfolio Manager and Head of Fixed Income, Ben Amons, joining us here today. Ben, thanks so much for the time. We appreciate it.
Thank you. Thank you for having us.
Definitely. Coming up, former President Trump says he's expecting to be arrested Tuesday. We're going to speak with the AGF Investments' Greg Valliere on what this all means. That's next. Former President Donald Trump wrote on Truth Social Saturday that he expects an indictment on Tuesday and called for protests. Trump noting that the use of a testimony from one of his fixers, Michael Cohen, does not hold the credibility needed to prosecute in the Stormy Daniels case. With nearly a year until the primaries begin, what is this impact expected to have on the U.S. election and markets? For that, let's get to AGF Investments Chief U.S. Policy Strategist Greg Valliere. Greg, what impact is it expected to have from your perspective, if any at all?
Yeah, you just can't make this stuff up. It's so wild. I honestly feel this is a plus for Donald Trump if he's in fact indicted, which I think is likely. I'm not sure it's Tuesday, but I think it's likely. Number one, it gives him publicity, which he craves. Number two, it gives him an opportunity to smoke out a lot of Republicans to see where they are. And number three, maybe most importantly, Donald Trump plays the martyr really, really effectively. And he now gets to play martyr, and I think it will help him politically.
If he's indicted, what are the rules around whether he can be president?
Well, it's unprecedented, isn't it? But at the same time, most legal experts would contend that you can indict a sitting president. The Justice Department has always been kind of cagey on that, but I think you can. You could even indict somebody who's incarcerated. It's not totally out of the question. So I think there is precedent. And, you know, Julie, the irony here is that there are better cases. I mean, this case with Stormy Daniels is not an easy one. It's also going to rely on the testimony of Michael Cohen, who's a felon. More importantly, there are bigger and better cases. Georgia, the January 6th case. So there are others to come.
Okay, so what is the reality of an actual tailwind from this indictment existing or perhaps bubbling up? Because even if we look back to some of the candidates who he had supported in past races, whether it be the midterms, whether it be the 2020 elections, and even runoffs as well, there have been significant losses or a lack of a wave that's been more like a puddle, as some political pundits have called it in the past too.
Well, you know, Trump could fizzle. I don't think he's going to fizzle right now. His supporters are more energized than we've seen in many months. But, you know, if there's another indictment out of Georgia and then still another one, you know, later in the year, Trump could start to lose Republican support because people may conclude he's got simply too much baggage. That's not out of the question. If that starts to happen, you know, DeSantis will get a careful look. But if it's not DeSantis, you have to ask the question, is there someone out there who could win a general election who's relatively moderate? I say yes. I say it's Glenn Youngkin of Virginia, the governor of Virginia, not well known around the country, but he won a stunning upset a couple years ago against Terry McAuliffe. And most importantly, perhaps, Youngkin is worth $500 million of his own money. He's a former Carlyle executive. So I think that Youngkin, after all the turmoil we're going to see this year, Youngkin is going to be one to watch.
Yeah, an actual multimillionaire. Imagine that, running for office and being able to use his funds.
Right.
Has this situation actually, in a weird way, done President Biden a favor? Because it's getting, you know, it's creating a lot of noise. And in the meantime, there are some foreign policy headlines that are maybe not so great for the president.
There's so much to competing narratives, so many competing narratives right now. You've got Putin's Z. You've got the banks. You have the possible problems with the debt ceiling and U.S. defaults. And now you've got this crazy political instability that I think will prevail for a while. So you're right. I think for Joe Biden, it's not an easy path, but I think his flaws may become overshadowed by the Trump flaws.
Is there any economic implication to all of this? And what is perhaps the top one that you would take away?
I'd say the top one is a sense of uncertainty. I think that the Republicans still haven't gotten their act together. They still have to come up with their own budget. And then we've got a huge debt ceiling fight. It might not be in late summer. It could be in early summer. We'll see. There could be a problem with receipts because of all the bank problems. But I'd say it's the debt ceiling. That's the one story that is going to get even more complicated.
Good to see you, Greg. Thank you so much for your perspective on all of these issues. AGF Investments Chief U.S. Policy Strategist Greg Valliere. Appreciate it. Coming up, a leadership switch up at Starbucks. What's brewing at the beverage giant next?
A big Fed interest rate decision, the state of the housing market, the TikTok CEO's first ever testimony before Congress. It's all coming up in the week ahead. Here is what you need to know. First up, February's existing home sales data will be released on Tuesday. In January, sales fell for the 12th month in a row, according to the National Association of Realtors. And given how mortgage rates have risen, it's likely that home sales will drop further. New home sales data will be released on Thursday. The focus will be on the Fed this week as Fed Chair Jerome Powell weighs whether or not to raise rates amid the banking turmoil. Some economists believe that the Silicon Valley Bank collapse will force a softer position on rate hikes. And Thursday, all eyes on TikTok, just not on the app. TikTok CEO Shou Chew will appear before the House Energy and Commerce Committee. Lawmakers are expected to grill him on TikTok's consumer privacy and data security practices, the platform's impact on kids, and the company's relationship with the Chinese Communist Party. This will be Chew's first testimony on Capitol Hill.
We've got some breaking news right now. Amazon is saying it is laying off an additional 9,000 employees. This news coming from CEO Andy Jassy in a memo to Amazon employees that is now shared on the company's website. He says that most of these reductions are going to be in Amazon Web Services, in the company's People Experience and Technology Solutions business, what they call PXT, in advertising, and in Twitch. He says this was a difficult decision, but one that we think is best for the company long term. And he also says, you might wonder why we didn't just announce this in January when we announced the elimination of 18,000 positions at Amazon. He says that the teams had not yet finished their assessments of what was necessary for this year, and they didn't want to rush through those decisions. So that's why this additional 9,000 is being announced today. And Brad, obviously each one of these represents somebody who is losing their role, but it is also just the bigger picture in the tech industry that efficiency is the name of the game right now.
Yeah, and that's the continued message that you hear from either Amazon or even Meta platforms that upped its own headcount reduction number, and as of recent as last week, as one thing that we've continued to see within these plans going forward, and especially with the announcement of Amazon here, even as they're communicating with these employees, is where that reshuffling of some of the headcounts, as you have massive layoffs that take place at the tech companies that have the largest headcounts out there, where those employees are able to find jobs elsewhere, because that's going to be critical in ensuring that we still do maintain some of the broader employment situation that has still continued to operate from a broader sense of strength. It's just a matter of, okay, where in this displacement are there the replacement or the filling of roles elsewhere that still remain open, even as more hiring freezes are starting to come on? I think that's what a lot of employees that may be impacted by this might potentially be going through their heads right now.
Yeah, I mean, we have talked to companies that are still hiring. We talked to Adobe last week, for example, and they talked about that they are still in hiring mode. One more thing I just wanted to mention that Jassy says he remains very optimistic, he says, about the future and the myriad of opportunities we have, both in our largest businesses, stores and AWS, and our newer customer experiences and businesses in which we're investing. So his tone is still, some of these announcements when they come with the cuts are taking a much more somber tone.
Right.
This is still saying we're getting leaner, but we're still focusing on growing. So we'll see what ends up being the outcome of all of this.
Yeah, there's a major kind of note to strike within your own communications as a leader through this times, knowing that there are such significant announcements impacting so many people that you are making, and for the course of the company going forward as well. Yeah. Also here, we got to talk about Starbucks.
Yeah, we do, because there's also a management change there, a personnel change, if you will. Starbucks officially naming Laxman Narasimhan, the CEO, this morning, taking the reins from three-time executive Howard Schultz 2 weeks earlier than expected. Brooke DePalma has been covering this for us, and she's here with us now. So it's only a 2-week difference, right? But still, Starbucks is not a haphazard kind of company, right?
Right. Certainly, this is something that we've been expecting, we've been planning for, and they've been planning for nearly 5 months. But Howard Schultz, in a letter to leaders this morning, calling this a new era for Starbucks. Of course, Laxman will take the role of CEO effective Monday today. He will also join the Starbucks board of directors, and interim Howard Schultz, interim CEO, that is, will step down, but he'll continue to remain on the board of directors. Now, as I noted before, this has been planned ahead. He joined the company October 1st. He's been transitioning into this role for the past 5 months. He spent that time meeting employees, going to manufacturing plants, and also support centers around the world. That he's even earned his barista certificate. And Melanie Hobson, she is the chair of the board of directors. She said that this intensive immersion allowed him to be uniquely prepared for this next phase of growth at Starbucks. But we know Loxman as the CEO of Lysol maker Reckitt Benckiser. He led that company during the pandemic. He was also former global chief commercial officer of PepsiCo. And in the release, he did say that he was excited to unlock the limitless future of Starbucks. But of course, there's a lot going on at the company at the same time.
Absolutely. So what do the next few weeks look like for Starbucks? I mean, they've got some big events that are going to be taking place in this near term.
Right, big events internally and also externally facing. Of course, this Thursday, we have the annual meetings of shareholders. Loxman will now lead that annual meeting of shareholders on Thursday as well. Shareholders are also expected to vote on a proposal from SOC Investment Group. Now, that proposal will require the Starbucks board to start succession planning at least 3 years in advance. Of course, we know here that Howard Schultz has said publicly that he does not plan to step back into that role as CEO, but he is expected to testify before the Senate Help Committee in response to accusations that Starbucks has not come to the table in terms of collective bargaining when it comes to employees looking to unionize, and that also they've been outspoken about not allowing employees to unionize. But under Howard Schultz as interim CEO, the company has seen returns at Wall Street. Certainly excited about that. We saw stock price go up 47% from his first call as interim CEO until his latest call. Stock price from April 4th, 2022, up 8%. We've also, as you noted here, seen the company market cap growth of approximately $40 billion. But there's lots going on at the company, and certainly shareholders expecting, I feel like, a bit more from Loxman as he takes the helm.
All right, a lot to continue to track with the ticker symbol SBUX and the green siren. Thanks so much, Yahoo Finance's own Brooke DePalma. And everyone, coming up, the SEC is reportedly investigating stock sales at SVB prior to its collapse. We're going to discuss that next.
We all know the FDIC protects your bank deposits up to $250,000. But what if you have your money in a brokerage account or even a credit union? We asked Bankrate.com Chief Financial Analyst Greg McBride.
If you have money in a brokerage account, this is something different from the FDIC insurance you have with your bank. Brokerages, if they belong to the Securities Investor Protection Corporation, they have this SIPC insurance, and that'll protect you up to $500,000 in losses in the event that the brokerage firm goes out of business. Now, that just protects the fact that your securities won't be part of that liquidation. It does not protect you against investment losses, and that's a key distinction. The value of your account's going to fluctuate. SIPC insurance doesn't protect you against that. If you have money with a credit union, this is likely federally insured as well. The National Credit Union Share Insurance Fund provides, similar to the FDIC, $250,000 worth of coverage to credit unions. Before you put your money in a credit union, just make sure that they are protected by that National Credit Union Share Insurance Fund. Just like with a bank, you want to make sure you're putting your money in a place that's federally insured. But as long as that's the case, you are protected up to $250,000, just as you would by the FDIC at a bank.
Just days before Silicon Valley Bank's collapse, executives of the company were unloading insider shares of the company in prearranged stock selling plans. The Justice Department and Securities Exchange Commission are now investigating the sales. While the probes may not lead to insider trading allegations, the approval of these stock sales while SVP was discussing a capital raise could have consequences. Joining us now to discuss is YouTube host Matt Kohrs. Matt, what have you made of what is public in terms of the planned stock sales versus what happened immediately thereafter?
I appreciate being here and happy to talk about it. It's, as the old saying, where there's smoke, there's fire. Yes, it could be just an amazing coincidence, almost like a Pelosi level perfect sale here. But I don't think so at all. I mean, it's one of these things where they filed the 10b5-1. Yes, we knew they were going to sell, but it was in January and then to be selling in February. And then a couple days after that, when the bank runs into some very serious troubles, I am of the opinion that and I get it, there's a huge debacle going on here. Is this the most important thing for everyone to be looking at? No, but I still am of the opinion that it should be looked at because the timing of it's a little bit too suspect in my mind.
And this, I know, feeds into a sort of a bigger narrative, right, about how retail investors' footing is compared to institutional investors or investors in the know, et cetera. So sort of maybe just another revelation of that, although it would be criminal wrongdoing, right? Don't get me wrong. It's not like this would be allowed. But I guess, Matt, what I would ask is just generally, how are you thinking about this regional bank crisis and how retail investors are approaching it right now?
Oh, that's a great question. There's so many things going on. So with respect to just regional banking and like that subset of really just the chaotic and erratic nature of the markets right now, retail, they're very, very vocal. So yes, they were calling out looking at, let's call it the alleged insider trading. But beyond that, a lot of retail, over $300 million worth of puts were set to expire in the money on Friday, but people weren't going to make money because the underlying wasn't trading. And a lot of brokers were telling people they're not allowed to exercise it. But because of the uproar within retail, finally, they were able to cave at the last second. This all happened last week, so finally a win. But this was very much being perceived as, once again, brokers seem to be placating, if you will, their market makers opposed to instead of their retail client. So I think that's one aspect of it. And I would actually say that's a great win for retail. But the general mindset is there's a lot of excitement. And I would argue what's traditionally thought to be quote unquote boring. Like we're seeing now that gold, it got above 2000. We're seeing a good push in silver, even TLT, some long-term bonds, but maybe because I'll say the cool kid on the block, a lot of excitement right now in Bitcoin. So I think we're almost seeing people pay attention to what's commonly thought of like as a store of value, or at least that's how it's pitched. But yes, also a lot of people are talking about, should we be dip buying some of these regional banks? And arguably that's higher risk, higher reward, but there is a lot of chatter about that.
Okay, since you mentioned Bitcoin, I mean, naturally, one huge thing that I thought about even coming into today's show was perhaps what a lot of people watching Silicon Valley on HBO years ago would have probably been thinking. Anybody who has some type of interest in making sure that the dollar, and banks, of course, do have that, that succeeds in the future, they're going to be betting against Bitcoin. But now that you have the wavering of confidence in those banks, you have Bitcoin now seeing this considerable move to the upside and stabilizing above 28,000. You know, what has been the chatter, the fodder for conversation around the cryptocurrency landscape from your perspective?
Oh, absolutely love this. And it almost connects to the previous question of just the chat about SVB. It's one of these things where you pull on a thread and all of a sudden it leads to so many other things. So yeah, we could be talking about banks, insider selling, maybe it's mismanagement. Why did they not hedge their interest rate positions? All of that. But as you get bigger here, we're starting to talk about other things of like, okay, potential weakness of the fractional banking system. We could talk about maybe did the QE party go on for a little bit too long, maybe 6 months too long? Do we even trust in the fact that we have a fiat currency not anchored to anything and the people who are unelected having a massive impact on our financial well-being? It is a great overall monetary and economic conversation. And yes, I think Bitcoin is a common answer in it. But the fact that the average person is now asking these pretty hard-hitting questions, for me personally, I think it's amazing because a lot of this financial education is just not simply taught here in the US.
I mean, I guess you could argue fiat's tethered to the full faith and credit of the United States government, which has worked well so far, by and large. But I mean, is this a debate? Is this like the hot Reddit debate that's happening right now, Matt?
I mean, it's definitely a conversation because like there's just so much chaotic nature in the market. But as you're alluding to of faith in the government, I mean, not long ago, we were called crazy people if we thought that $5 trillion being printed within a year would cause inflation. We were told, no way is that going to happen. And then when they kind of caved and said, okay, maybe people are right, we were told that it was transitory. So in the long run, the general sense of faith in the government, well, I see what you're saying there. And arguably, we probably have bigger issues if we no longer do trust them. But in the short term, on certain matters, I mean, they've definitely had various follies.
Yeah, good point. And we have bigger problems if we don't trust them. But certainly a lot of people are going into crypto right now because they are asking those questions. And we're seeing that resurgence. Matt, good to catch up with you. YouTube host Matt Kors giving his perspective for us today. Coming up, stay tuned for our 3 to 5 show. Shauna Smith and Dave Briggs today have EY chief economist Greg Dacko. He's going to explain why the banking crisis could heighten the risk of a recession and what it all means for the Fed. That is coming up later today, but we'll be back in a minute. Got some big interviews on tap on Yahoo Finance today. Rochelle Akufo is going to speak with a professor from NYU for a deeper context on that Credit Suisse rescue.
That's right. Plus, we'll speak with one wine company who had money in since failed Silicon Valley Bank. What this means for that industry coming up in the next hour.
And the trouble for Ticketmaster continues. Rochelle's also going to speak with one analyst on the ticket site's latest move to refund Cure fans. Ooh, I know some of them, actually.
Oh, yeah?
Yes, I do. Let's also get a check on markets here. We've got stocks that are mixed, but I'm taking a look at Amazon as well. We just got that announcement from the company that it is laying off an additional 9,000 workers on top of the 18,000 that were announced earlier in the year. The stock had been down fairly sharply earlier in the session. Now it is down. It's still down, but it's not down by as much. But still, it's a lot of people that we're talking about here. I'm just checking. Amazon, as of the end of last year, did employ 1.5 million people, just to put this in context here. So it is a lot of individuals, but as a percentage of Amazon's total, it's still not a huge number.
Yeah, and as we're continuing to take a look at the NASDAQ 100, just want to zero in on technology for a hot second here. This is one sector that is in the negative territory on today for the S&P 500, 11 sectors. That's down by about 0.5% right now. It's the lone laggard, which is why I zero in on this. However, if you look at this over the course of the past 5 days or 7 days, that is one of the biggest gainers that we've seen over that period of time. So earlier, as we had started off the trading session, it was really consumer discretionary technology that were the lone laggards there. But
so some give back today, and the banks now are in the driver's seat and leading the gains today. Well, we've got a lot of guests. We've got a lot more market coverage coming your way. Rochelle Akufo has you for the next hour of trading. We'll be back tomorrow.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Banking on a turnaround. UBS's 11th hour rescue of arch rival Credit Suisse, creating something of a relief wave with the Dow and the S&P pushing higher, but it's still a choppy day for investors. Now, Credit Suisse shares plummet while wider European banks try to stage a recovery. And the next shoe to drop, we're keeping an eye on the US regional banks, none more so than First Republic. Shares in the group nosediving after yet another downgrade by S&P Global. A better day for the majors though, JP Morgan and Goldman Sachs trading in the green. And what does all this mean for the Fed? When the immediate aftermath of Credit Suisse's deal, central banks across the globe joined forces to make sure the US dollar remains available across world markets. Is this a positive sign or a major red flag? We'll get into that debate. Well, first, let's check in on the major indices. Started in negative territory, then we're mixed, and now we see keeping some of the gains as we're picking up in this 11 a.m. hour. You see the Dow there up more than 1% on the day, more than 330 points. The S&P also seeing gains there, up 30 points, about 0.7%. A bit of a laggard, as we were mentioning earlier, for the Nasdaq. Some of these tech-heavy hitters really weighing, but still at least in positive territory, though tech at the bottom in terms of sectors on the S&P. Let's also check in on the Treasury market, always keeping an eye on some of this flight to safety. We see the short-term yield especially seeing strong gains there, up almost 2% on the day. The 10-year also up about 1.5% there, and the 30-year longer-term yield up just 1% ahead of the FOMC meeting coming up this week and what we'll be watching for with potential rate hikes. Right, well, Swiss bank UBS agrees to buy rival Credit Suisse in an attempt to ease banking panic. But how did Credit Suisse get into such a bind? Here to break down the latest is Yahoo Finance's Shauna Smith. Hey, Shauna.
Hey there, Rochelle. All right, so let's go through it here because UBS is buying arch rival Credit Suisse. It's an emergency rescue deal aimed at stemming some of that panic that we certainly have been seeing from the ongoing banking crisis. Now, the collapse of Silicon Valley Bank, that may have been the immediate catalyst, but the turmoil for Credit Suisse, well, that actually goes back much further. So let's get into all this. Now, it suffered years and years of reputational damage due to a series of controversies. Now, the most prominent being the so-called spying scandal. That was when a former wealth star manager, a star in their wealth manager there, had really directed some of the attention to the group of instigating a surveillance operation after he defected for UBS. Now, it led to the resignation of CEO Tidjane Thiam. Things got even worse when you fast forward to March 2021 with the investment bank losing $5.5 billion from the collapse of hedge fund Archegos. Credit Suisse also had to freeze $10 billion in supply chain finance funds linked to Greensill Capital, an investment that was sold to clients as low risk. All this happening amid a long-standing push to restructure the bank. Several executive changes later gets us to July 2022. Credit Suisse names Ulrich Körner as CEO. 3 months later, it ramps up some of these changes, including massive job cuts, spinning off its investment bank division. And that is also when Saudi National Bank took a 9.9% stake. Fast forward now to this year and even more red flags. This month, shares were hit again after it delayed its annual report due to what it called, quote, material weakness in its financial reporting. The big hammer blow, though, that was when top shareholder Saudi National Bank said that it will not increase its stake because of regulatory constraints, right around 9.9%. Well, that was enough to send shares plunging by as much as 30%. Now, on Thursday, Credit Suisse did secure a $54 billion lifeline from the Swiss National Bank. And this is significant because it was the first major global bank to get emergency funding since the financial crisis. But that, though, was not enough for the embattled lender. After days of talks here with management assessing some of the strategic scenarios, UBS did agree to buy Credit Suisse for $3.2 billion in stock and assume up to 5 billion francs in losses. That was a deal orchestrated by Swiss regulators to try and help calm some of that turmoil that we have certainly been seeing in the banking sector, Rochelle.
Certainly that last push as the Saudi money came out was certainly that last push, but obviously a series of incidents leading up to this collapse of Credit Suisse. Thank you, Shauna Smith there for us. Well, as UBS is set to acquire rival Credit Suisse, the U.S. Federal Reserve teams up with central banks to prevent liquidity issues by making sure dollars remain readily available across the global financial system. We're here to discuss the state of the banking system is Lawrence J. White, NYU Stern Professor of Economics. Thank you for joining me this morning, Lawrence. So first, put into context this fall from grace. Of course, this fall from grace for Credit Suisse. This is a very storied bank. Put this into context, into what this actually means for the broader industry.
Well, it's storied, but alas, for the last 10, 15 years, the stories haven't been very good. It's been very poorly managed. And, with a garden variety corporation, a poorly managed company, that's a problem for the shareholders, maybe for the employees. But with a bank, it has larger consequences because banks are so important as part of the financial infrastructure of any economy, and nowadays the financial infrastructure of the global economy. So Credit Suisse, that storied past, the last 10, 15 years, not very good stories.
And we know that what ended up breaking the bank in the end ended up being these rapid net outflows, this concern about this liquidity crisis. But that did seem to be more the issue than looking at what happened with actually Credit Suisse's assets. So why did they need Swiss authorities then to backstop the valuation?
Well, banks are very fragile. Once depositors and other creditors who can pull their money out at short notice, once they start getting nervous, the basic structure of a bank falls apart. We saw that a week and a half ago with Silicon Valley Bank, where the depositors got nervous. On Thursday, a week and a half ago, over $40 billion was pulled out of Silicon Valley Bank. It's not a good thing to have a major financial institution being run on. Again, this is different from your garden variety corporation. Banks are central to the financial structure of an economy, but they are fragile. And so, especially something like Credit Suisse, $500 billion in assets, second largest bank in Switzerland, it gets in trouble, its depositors and other creditors start running, the Swiss government has to do something.
So then what is the cost to the broader banking sector of having to make this rescue, though, for Credit Suisse?
Well, the rest of the banking sector, I'm sure for the last couple of weeks, they've been looking at their exposures to any transactions with Credit Suisse. They're being cautious, and so there's no direct consequence. The indirect consequence is this phenomenon that has been called contagion, that when the creditors of one major bank start getting nervous, when the depositors start pulling their money out, depositors at other banks start getting nervous as well. Banks are complex. Almost all depositors don't have the expertise to figure out, is my bank solid or not? But if they start getting nervous, they start saying, better safe than sorry, and they pull their money out, then yet other depositors start getting nervous, and we have contagion or runs on the bank. Again, a week and a half ago, we saw that with Silicon Valley Bank. The worry was we might be seeing it in the international sphere, not because of any direct connections, but this general contagion problem, nervous depositors, nervous creditors.
And as we look at some of these other distinctions, you note that adequate capital is an issue that European banks face. Talk more about that and what this might potentially mean if you're a US investor looking at what's happening with Credit Suisse and wondering about any connections there.
Right. Capital is the important concept. It's the buffer against losses. It's the difference between the value of the assets and the value of the liabilities. The bigger the buffer, the better a bank can withstand losses, and also the stronger the incentive for the bank not to be taking undue risks because the owners have more to lose. Capital is roughly the equivalent of owner's equity or net worth. If I were an equity investor, I would only want to be investing in solid, well-capitalized banks. Otherwise, I face a significant risk that that bank could exhaust its capital and my investment is gone. If I'm a depositor, I want to be concerned, is there deposit insurance? Am I covered? Are there limits? How quickly do I have access to my money? But being a depositor is different from being an equity investor. But at the end of the day, both categories, you care about the financial stability, financial resilience of any bank or other financial institution that you're doing transactions with.
I'm sure we'll expect a lot more scrutiny of people's banking relationships in the light of all of this. A big thank you there, Lawrence J. White, NYU Stern Professor of Economics.
We're all triply aware now. Absolutely.
Indeed. Thank you for joining me this morning. Well, Swiss bank UBS set to buy Credit Suisse as central banks look to ease banking panic. But our next guest says this move will likely magnify Credit Suisse's problems. Here to discuss this and more is Michael O'Rourke, Jones Trading Chief Market Strategist. Good to see you, Michael. So you actually, in your note, talk about this acquisition of Credit Suisse, taking this from a $500 billion problem to a $1.8 trillion problem. How so?
Yeah, I'm not a believer that when you have, a problem, the solution is to make it a bigger problem. And I think that's the risk that the regulators have undertaken here. When you have these banking crises, these banking panics, I think it's better to, handle them one at a time and target your response. So when you think about when Bear Stearns fell back in 2008, JP Morgan acquired them. And, it created volatility and it undermined confidence in JP Morgan for a time being. In the end, JP Morgan did fine. But while you have this ongoing volatility, you just don't want to create the potential for greater fear in a larger institution.
So then, Michael, what should banks be prioritizing right now?
Well, obviously, the big concern is, as Professor White just says, deposits. Every bank is looking to maintain their deposit levels, and that is the issue that we're having here, especially in the United States right now. Basically, with the pandemic response between monetary and fiscal policy, we saw a 35% increase in deposits in 2020 and 2021, and the banks had to basically put that money to work to earn a return. And what happened is, relative to the overall deposit base in the country, the insured base dropped to relatively low levels historically. And now that you're seeing some banks overreached while investing that capital or investing those deposits, they've raised significant concerns here that depositors want to make sure they don't lose their money. And we've seen deposit flight, and that's been the source of concern here in the United States for the past 10 days or so.
So then, as people are looking for some solutions here, expanding and modernizing FDIC insurance has come up, but what should be the parameters around that, being that we do now have digital banking and we do have this megaphone in social media that can spread information and misinformation instantaneously?
And that's key, right? Because the information is traveling so quickly here that the regulatory structure is not prepared for it, basically is the way to describe it. And this is all a new phenomenon over the past decade. So obviously, I would say the $250,000 insurance threshold is too low. It was set back in 2008. And I think there's a number of different ways you can go about it. I would think it would need to be at least double. I'd say you compare it to the level of the economy. The economy is about 85% larger today. Or you can compare it to the level of insured deposits, which is probably about 110% larger today than it was in 2008. And just on those metrics alone, you get to a number north of 500,000. But there's a number of different ways the regulators can choose to do it. But the one thing that becomes abundantly clear is that the $250,000 threshold is way too low. And then you've had Elizabeth Warren this weekend say it should be $1 million or $2 million. So I don't even think you need to go that far. But if you updated it to somewhere north of $500,000, I think you'd stabilize a good portion of the banking system in this country.
But Michael, you have to wonder then, does it take some of the risk out of it if you know that the FDIC can just step in? I mean, we saw that Kevin O'Leary was on CNN saying he would never put money into a bank stock again because President Biden had essentially nationalized American banking, making it less profitable for shareholders long term. What's your take on that?
No, I don't believe that's necessarily the case. I mean, obviously, we've had the deposit insurance since the 30s. So this is something that's been, we've had for a long time, and it's been an important stabilizing factor in the banking industry. I think every so often we have to modernize and update banking regulations, but generally it's a good business. Again, no depositor is going to put their money in the bank for what has been, especially for the past decade, a pretty minimal return if their money's at risk of loss, just because bankers make poor decisions. So basically, you definitely need that level of protection there. And I think it's something that once it happens, the banking industry will stabilize, and it is a very profitable business. I think that's abundantly clear, and we've seen that we've come through the financial crisis in 2008 and 2009. And many institutions are so much stronger. But again, you're always going to have someone who goes a little too far, someone who reaches a little too far for yield, takes too much risk. And once in a while, those players have to be, there has to be some volatility so that they get shaken out. But overall, the systems are one that's worked very well for our country.
And Michael, obviously, the Fed keeping an eye on that while preparing for the FOMC meeting this week. In terms of what's going to have the most impact on the economy slowing down, rate hikes or what we're seeing in terms of a tighter credit and loan environment that might follow now from this bank run?
Yeah, I think, I've been a person who thinks the Fed should have hiked rates earlier and have been an advocate of them hiking rates. I think that would be a big mistake to do that this week because, as I said, the bank's primary concern right now is sustaining their deposit base. They're not worried about originating loans and extending credit at the moment. So we should expect to see a slowdown in credit growth in this country, which again, that will slow inflation, that will slow the economy. So I think the Fed has to be a little forward-looking going into this meeting and say, right now is the time to pause. If the banking industry snaps right back in the next several weeks or month, they can always raise rates at the next meeting, but right now is the time to see how the dust settles here and make sure that the banking system's stable.
We'll have to see. They do tend to look at that lagging data, so hard to gauge whether or not they'll take that forward approach here. Michael O'Rourke, thank you so much. Jones Trading Chief Market Strategist, thank you for joining me this morning. All right, coming up, turmoil in the banking sector stealing the headlines, but there's the potential for big developments on the geopolitical front as President Xi Jinping visits Moscow. We're across that story next.
We all know the FDIC protects your bank deposits up to $250,000. But what if you have your money in a brokerage account or even a credit union? We asked Bankrate.com Chief Financial Analyst Greg McBride.
If you have money in a brokerage account, this is something different from the FDIC insurance you have with your bank. Brokerages, if they belong to the Securities Investor Protection Corporation, they have this SIPC insurance, and that'll protect you up to $500,000 in losses in the event that the brokerage firm goes out of business. Now, that just protects the fact that your securities won't be part of that liquidation. It does not protect you against investment losses, and that's a key distinction. The value of your account's going to fluctuate. SIPC insurance doesn't protect you against that. If you have money with a credit union, this is likely federally insured as well. The National Credit Union Share Insurance Fund provides, similar to the FDIC, $250,000 worth of coverage to credit unions. Before you put your money in a credit union, just make sure that they are protected by that National Credit Union Share Insurance Fund. Just like with a bank, you want to make sure you're putting your money in a place that's federally insured. But as long as that's the case, you are protected up to $250,000, just as you would by the FDIC at a bank.
I opposed Chair Powell for his initial nomination, but his renomination, I opposed him because of his views on regulation and what he was already doing to weaken regulation. But I think he's failing in both jobs, both as the oversight manager of these big banks, which is his job, and also what he's doing with inflation.
A heated message there from Senator Elizabeth Warren, who has not been shy in sharing how she feels that Fed Chair Jerome Powell has handled both inflation and the banking crisis. For more on how Washington, D.C. is reacting to the current bank crisis, let's bring in Yahoo Finance contributor Kevin Cirilli. Good to see you, Kevin.
Good to see you, too. She's not a fan of Fed Chairman Powell and minced no words there over the weekend on the Sunday shows. But one of my top three things to watch this week as it relates to the banking and financial services sector is that cap, especially for medium and small sized banks. And this could be the one area of bipartisanship that we're seeing from Republicans and Democrats in wake of the last 2 weeks on this particular issue. What she said to Meet the Press as a result of lifting that threshold was, quote, lifting the FDIC insurance cap is a good move. Now, the question is, where's the right number on lifting it? But recognize that we have to do this because these banks are underregulated. And if we lift the cap, we are requiring or relying even more heavily on the regulators to do their jobs. Now, also speaking out over the Sunday shows was House Financial Services Committee Chairman Patrick McHenry, a Republican, of course, who went on to say that he, too, is in favor of lifting the cap. He went on to note that cap and that threshold was actually lifted after the 2008 financial meltdown from 100,000 to 250,000. But again, now they've got to get together and collectively decide what that threshold would be. And it could be, I'm hearing, the type of regulation that President Biden would back that he alluded to last week as well.
And Kevin, we know that you're also watching China's Xi Jinping visiting Moscow. Yes. Tell us more about that.
Well, look, Xi Jinping has touched down in Moscow to meet with Russia President Vladimir Putin. This comes after China outlined what they're calling a 12-point plan for Russia in order to de-escalate the tensions for Russia's egregious war with the Ukraine. Now, White House National Security spokesperson John Kirby has said over the weekend that if there's a ceasefire announcement or calls for a ceasefire, that's the result of this meeting, that would not be something that the United States would deem as a positive step. He said, quote, if coming out of this meeting, there's some sort of call for a ceasefire, that's just going to be unacceptable. John Kirby's words from the White House. Kirby is expected to brief reporters at the White House later today. But again, it just goes to show you that the U.S. and NATO and European allies are really greeting this meeting with a lot of skepticism. And they're also wondering whether or not China is going to provide any sort of assistance militarily or economically as they have for Russia. And we should note that ICC recently, the International governing body of ICC recently put out a warrant for Putin's arrest. So a lot moving on the Xi-Putin dynamic with the rest of the world.
And speaking of law and politics, you're also watching the drama with former President Donald Trump unfolding, who claims that he's going to be arrested.
Yes, over the weekend, former President Donald Trump taking to the ultra-conservative social media platform Truth Social, saying that he's going to be arrested. We don't know, obviously, if that's going to be the case, but it really did invoke January 6th social media posts in which he had urged his supporters to convene and to rally on January 6th. So you've got now, I think, two things. One, Trump could be potentially indicted. We should note that polls have him as the front runner for the 2024 Republican nomination. And this would be, of course, the first time that a former United States president is indicted. This over the Stormy Daniels investigations and the hush money allegedly that he had paid to Stormy Daniels. But secondly, what impact does this have on the 2024 race? Trump's running likely against Florida Governor Ron DeSantis, who just came out this morning and kind of poked fun at Trump for the allegations of Stormy Daniels. But what does it have the impact on big money donors who are weighing whether or not to go with Trump again in 2024 and to back his campaign or to choose a different candidate? And that's what we don't know. But Trump, for his part, trying to lure in small dollar donors from his base, he's actually put out a fundraising video, get this, just within the last couple of days, trying to fundraise off of a potential indictment.
Goodness, I mean, certainly always an opportunity to be found, at least. Kevin Cirilli there, thank you so much for that update.
Thank you.
All right, time now for your trending ticker. And there's more pain at Amazon, the e-commerce giant announcing it will cut a further 9,000 jobs. The layoffs are in addition to the cuts that began in November, those impacting 18,000 staff. In a memo to employees, CEO Andy Jassy reiterated the goal of becoming a leaner organization. The cuts likely to fall on their advertising, HR, and cloud computing divisions. The stock there down just slightly, about 1.6% on the day. All right, checking in on the markets here, sponsored by Tasty Trade. We're still seeing a lot of buying action going on, especially in the Dow. We're seeing the Dow up there, almost up about 350 points, up about more than 1%. The S&P 500 also seeing gains there, up 0.8%. Tech-heavy Nasdaq there, also enjoying some gains there. More buying action as well, up more than 40 points on the day. Getting a little bit of encouragement there from that Credit Suisse rescue from UBS. All right, coming up, the dominoes keep falling. California wineries are feeling the squeeze in the wake of SVB's shutdown. We'll take a litmus test of that industry next.
The wine industry is unique. It's been very, very, very successful in California. Some of the varietals we make, we're all proud of. But clearly our cost of capital, and I say this as a participant, is probably going to go up 30%. No question about it. It's going to make the larger operators probably more protected around a moat, and the smaller ones are going to be acquired by the larger ones. It's going to force consolidation in the wine industry.
Last week, O'Leary Ventures chairman Kevin O'Leary warned of trouble ahead for California wineries in the wake of SVB's collapse. Now, the bank boasted a well-equipped wine division, issuing over $4 billion in loans over more than 25 years. Many vineyards are now unsure of where to turn. Joining me now is Connor McMahon, the owner of Full Draw Vineyard in California, who banked with SVB. Thank you for joining us this morning. So, Connor, walk us through what it was like when you sort of first started hearing the information about SVB's demise, and what's that done to your business over this course of this past week.
Well, thank you for having me on, first and foremost. It was a very nerve-wracking thing, especially being a small startup winery here in Paso Robles, California. We really try to focus on organic and sustainable wines. And so I think partnering with Silicon Valley Bank was, at the time, a very smart idea for us. But rewind to the week that we started seeing Silicon Valley Bank stock price start to tumble, and we didn't really know where that was going to leave us as a small winery. But that Friday morning, we started to scramble trying to figure out how to get our merchant processing, our credit card processing hooked up to another bank, because we had no idea what the fallout was going to be with Silicon Valley Bank.
And what was that process like of trying to sort of switch from one bank to another? I know you do still have some accounts within SVB.
We do. That process was, fortunately, we've got great personal connections here in Paso Robles with other banks. So getting that checking account open was a pretty fast process. But really, with the uncertainty of all of our loans that we have with Silicon Valley Bank, we really didn't know where that was going to leave us. It was a pretty scary time. And just having access to our funds was the biggest issue, because being locked out of our operating line of credit, we had no way to know if we were going to be able to make payroll and continue operations in the vineyard. So really getting capturing any revenue that we had coming in through the winery was our most important goal, and getting that other checking account open with the other banks was very important.
And I can imagine it must be particularly difficult, given the seasonal nature of your work, given the time, 7 years on aggregate, in order to really go from planting to being able to produce a wine here. What has that done for your margins and perhaps your strategy and how you plan on banking?
Really, that's going to lock us in with a bank that we can trust long-term, just because, like you said, when we plant a vine, it takes about 7 years for us to see any sort of return on investment, because it takes 3 to 4 years of the vine to be able to come to maturity to produce fruit, and then another 2 years of barrel age and bottle age. So really, when you look at that timeline of 7 years, that really creates a very narrow margin for error. You really need to put out a great product, which is what we work hard at doing here, because we have to be able to show our consumers that what we have done over those last 7 years makes it worth it to purchase our product and consume our product.
And in terms of what happens next, I mean, the FDIC is still looking for bidders to purchase this bank, and they've had to extend that deadline, didn't have enough bidders. What do you think this does, though, seeing this collapse of SVB, and especially when you have such a niche sector here? What does that mean for the future of California wineries?
That's a very interesting question. I think what it's going to do is probably push some wineries to finding outside funding versus finding banks, because you have a little bit more stability with some of those investors. We really are looking forward to the future to see where that's going to take Silicon Valley Bank, and having one of their buyers come in, we don't know where that leaves us. So really, with the future being unclear, it's really hard for me to answer that question.
Yeah, it's understandable. Obviously, still a lot going on here, still a lot being unraveled. A big thank you there, Connor McMahon, owner of Full Draw Vineyard. Thank you for your time this morning.
Thank you very much.
All right, time now for our chart of the day. You're looking at the Bloomberg's Financial Conditions Index. Now, this index tracks the overall level of financial stress in the U.S. bond and equity markets to help assess the availability and cost of credit. You can see on your screen that the index went from loose in the green to the tightest since March of 2020. Now, green shows accommodative conditions. Red shows the opposite. Now, tighter conditions, this could be something for the Federal Reserve to watch on Wednesday when considering its rate hike decision. All right, coming up, lots of volatility out there today, but one asset class likes the turmoil. Bitcoin following gold higher in this session. Is this the true haven demand or just an excuse to bid up crypto? We'll discuss next. Keeping an eye on Bitcoin moving higher today, the cryptocurrency surged last night on the announcement that the Switzerland-based bank UBS reached a deal to buy rival Credit Suisse. Also in focus is the potential rate pause or hike by the Federal Reserve. For more on what impact that's having on the crypto market, let's get to Yahoo Finance's David Holleris. Hey, David.
Hey, Rochelle. It's been a very interesting past 10 days, I guess we could say, for Bitcoin. It's been on a tear. And, there's two things going on here. And one is the fact that, we've been into a couple weeks of what we would call a banking crisis. And that's obviously changed how the Federal Reserve might need to react in its upcoming rate hiking decision that's set for Wednesday. And so as a risk asset, a lot of analysts I'm speaking with, or I have been speaking with, have been saying that Bitcoin and other risk assets are poised to do well in the near term. Technology stocks have benefited a little bit from this, but Bitcoin by far has sort of outperformed other assets. Goldman Sachs put out a research note on Friday before Bitcoin sort of crossed this $28,000 hurdle, pointing out that it far and away was the best performing asset of 2023 so far, so year to date. So that's interesting. And then we have this other sort of story, which, Bitcoin diehards sort of believe in, which is that Bitcoin is, its purpose was, when it was created, was to sort of not be in the control of government. And given that we're seeing, sort of this banking crisis issue, Bitcoin is sort of being viewed again as a safe haven. That being said, investors have thought of it like that for a long time now. And that's often debated. And for the last 2 years, it was debunked. But it looks like, that narrative is sort of coming back into the market. I think, the problem of deciphering the two is that it really comes down to the fact that both are happening right now. So in terms of Bitcoin's trajectory, that obviously looks good for it. We're going to need more data before we can sort of see if investors are moving to it as a safe haven asset. But interestingly, its correlation, so how much it moves compared to gold in the NASDAQ. NASDAQ you can think of as technology stocks. Gold, it's traditionally thought of as a safe haven. Bitcoin has been correlating more with gold recently and less with the NASDAQ. So that's been a change that we've seen over the last 2 weeks, and we'll continue to watch that. But in general, Bitcoin compared to other crypto assets is definitely seeing the highest bid right now.
I certainly wasn't expecting Bitcoin to go back to being the safe haven after, the wild ride that it's been on there. So what are the expectations here? We know there are always these astronomical sort of predictions as to where Bitcoin could go. How much more of this will we need to see, though, before we can say, yes, this might actually be the turning point for crypto?
Yeah, it's a good question. I mean, I think if you're looking at the crypto market, Bitcoin including, about a month ago, things didn't necessarily look so bright. And now we have people coming out with a $1 million price target in 90 days or 87 days, I guess, is what we've seen. And that looks like it has about a 1% chance of being true. But, I think that if risk assets stand to benefit, and Bitcoin is not something that is, as connected. I mean, it's less connected from the banking system than it's ever been. I think hedge funds, at the very least, will look at it as a way to play on a macro narrative that is more beneficial to risk assets right now. That's what it sounds like from what I'm hearing.
Certainly one to watch, and we'll see what happens when we get that rate pause or hike, whatever the rate announcement ends up being from Jay Powell this week. Yahoo Finance's David Hollerith, thank you for that breakdown. All right, coming up, another fee debacle for Ticketmaster causing chaos for concert goers. Will fans get a refund? And is there any long-term solution? We'll discuss next.
unrealized losses.
The unrealized losses.
We've been hearing the term unrealized losses a lot lately, but what does that mean? It's basically losses that are on paper. If you have an asset on your balance sheet as a company, an institution, it fluctuates in value, right? Because it's something that is pegged to the market. If that asset has gone down in price on paper, that is on your balance sheet, you have recognized a loss, an unrealized loss. That loss only becomes realized when you have to sell that asset if the price has gone down. One maybe easier way to think about it is to think about a real asset that might be on your personal balance sheet, like a house, for example. Let's say that you buy a house at $300,000 and you live in that house for a while, but then something happens in the housing market. The price of the house goes down a little bit, say to $250,000. That means it's an unrealized loss. You haven't sold the house, you still live in the house. If something happens and you're then forced to sell that house, you take a realized loss. That unrealized loss becomes realized because you've made the sale. But let's say you live in that house for a while longer and the price goes up. Well, then you don't have an unrealized loss anymore. You actually have a gain. So that's how we can think about these various issues. These losses don't become realized unless, like some recent companies in the news, you are forced to sell for whatever reason.
More ticket controversy for Live Nation. This time it's outrage over inflated prices to see The Cure. According to various testimonies on social media, the addition of various processing and servicing fees jacked up the price of a $20 ticket to well over $100 in some cases. Now, the band's co-founder and lead singer Robert Smith taking to Twitter saying he was, quote, as sickened as you all are over the fees for the concert. Now, it's just the latest high-profile scandal involving Live Nation-owned Ticketmaster. Last year, so-called Swifties were up in arms when they were unable to buy tickets to Taylor Swift's last tour. The Live Nation CEO was grilled in front of Congress earlier this year on that very matter. He was grilled by senators, not Swifties, in case you were wondering. Yahoo Finance has reached out to Live Nation for comment. And joining us now for this conversation is Brandon Ross, Lightshed Partners Media and Technology Analyst. Good to see you, Brandon. I mean, it did seem like public shaming in the case of The Cure did seem to be what happened here, at least for getting some people some partial refunds. But what should we be looking at long term when you look at some of the fees that keep getting tacked on?
Sure. There's a number of issues currently facing the broader ticketing industry. I think fees is just one of those. And obviously, you had a lot of fans and Robert Smith himself up in arms over the fact that the fees were larger than the ticket price in this case. The problem that you have is I think there's a real lack of understanding, sometimes from the artist perspective and definitely from the fan perspective, as to where those fees are actually coming from. In the case of The Cure, you had half of the fees going directly to the venues to cover things such as parking and other services that are given at the venue. And then half of the ticket portion of the fee went to Ticketmaster, and half of that actually goes back to the venues. So the venues are taking 75% plus of that fee, and Ticketmaster only 25%. And I don't think most fans actually understand that.
Because it does seem to be Ticketmaster is the name that's really getting, slandered out there on social media.
Yeah.
Why do you think we're not seeing as much focus on the venues? What should be being done at that end?
Well, I think what needs to be done really is real transparency for the consumer. I think you have to start with an all-in ticket price, which has been advocated by Live Nation in the Fair Tickets Act. And then you should tell consumers exactly where those dollars are going and why, and really educate the consumer. Right now, Ticketmaster is the direct link between consumers and the tickets themselves. So they're taking the majority of the blame.
And we know that The Cure was really trying to get around this idea of some of these scalpers bulk buying some of these tickets. So they opted in just for the verified fan program versus the more expensive options. But if it's a venue issue, does it really matter then when you do things like just going for the verified fan option?
Sure. Well, let's not conflate two different issues here. One of the issues that you highlighted earlier is the fees on the ticket itself, and the other is the scalper issue. And in these situations, especially for the cure where they price tickets very low, scalpers are really incentivized to get their hands on those tickets so that they could resell them at a really large profit. Verified tickets is one tool in the Ticketmaster arsenal to stop that from occurring. And it seems to have worked to a great degree, not just for the Cures on sale, but also for the Taylor Swift on sale. But you're not going to be able to stymie all of those tickets from being taken by scalpers. You can use other tools though, and in this case, they used the idea of not being able to sell secondary market tickets at a markup, having a fan exchange program for secondary. It's something that Pearl Jam did first on their most recent Gigaton tour.
And is there any lessons that they could learn perhaps from how venues in other countries? I know, for example, when I was looking at Beyonce tickets, it was cheaper for me to fly to London and get good seats than to pay all the fees that got tacked on. Are there any good examples of countries or venues that are really getting this right?
So in the United States, there's a venue exclusivity model where venues are going to contract with just one ticket seller. In international markets, the promoter is going to decide how to distribute the tickets. I don't think that's the reason, though, that ticket prices are so much higher for Beyonce in this market. I think it's really what the market itself, from a demand perspective, is going to support. If you had a British band, I don't know, like Radiohead touring, that's much more popular in the UK than the US, you're probably going to see much more demand. And you'll have things like platinum pricing that are going to respond to that demand and price tickets much higher in those markets.
I guess for now, I'll just be watching Beyonce from my couch because I just can't do it. Well, Brandon Ross, thank you so much. Lightshed Partners Media and Technology Analyst, thank you for your time this morning.
Take care.
All right, coming up, you're very welcome. Coming up, weak guidance is sending shares of Foot Locker lower this morning, despite a big earnings beat in the fourth quarter. We've got that story and more in Trending Tickers coming up. Stay with us. before we let you go, let's take a look at some trending tickers. Keeping an eye on Foot Locker there, had strong Q4 results, but a soft earnings outlook, that weighing on the stock today. As you can see, they're down about 1.6%. And meme stock Bed Bath & Beyond, they're also taking a hit. They're down almost 18% on the day. So keeping an eye on those for you. Now, we're going to have a lot more coming up later on today on Yahoo Finance, so be sure to stick with us. We'll have EY Chief Economist Gregory Dacre joining the show in the 3 to 5. He'll explain why the banking crisis could heighten the risk of a recession and what it all means for the Fed. Shauna Smith will have that for you. Plus, we've got a busy week on deck. On Wednesday, the stakes get even higher for the Federal Reserve as the instability within the financial sector puts additional pressure on the central bank when it comes to rate hikes. Many economists are expecting a quarter-point increase. And then on Thursday, TikTok in the hot seat. The company's CEO gears up for his first date with Capitol Hill, but we're not expecting love at first sight. Lawmakers are expected to grill him on data privacy and the company's impact on children. We'll keep you covered all week on Yahoo Finance Live. Right, well, before we go, let's do a final check of the markets to see how they're faring as we head into the noon hour. Turning to a mixed picture here, but only slightly, as the Nasdaq just dipping into the negative there. The Dow there also, and the S&P gaining as we close out. That'll do it for now. I'm Rochelle Akufa. I'll be back with you at 11 a.m. Eastern. See you then.